Imagine a bank earning profits every year, yet collapsing overnight. Why does this happen? Not because of lack of business, but because of poor financial management and unmanaged risk. BFM Module A is where you learn how banks actually survive. It explains risk, return, liquidity, capital, and cash flows. The real forces deciding whether a bank grows or fails. If you are a banker or CAIIB aspirant, this module is not optional, it's foundational. Watch this session carefully because module 8 does not help you just pass the exam. It changes how you think as a banker. So let's start with the class. Exchange rates and Forex business. The two most important terms are there in this chapter's name. First one is exchange rate. Can you tell me that what is the meaning of this exchange rate? That what is exchange rate? See, if we say the definition of exchange rate in easy way, that exchange rate means what is the rate of one currency in comparison to another, right? And what is this Forex business? Forex, FX and foreign exchange business. These terms are same, right? So what is the meaning of this Forex business? Forex business, we can say that this is basically foreign exchange market in the global decentralized marketplace for exchanging the national currencies. As you can see, the last cycle, December cycle, BFM questions are quite difficult. Yeah, right? Moderate to difficult. If you have the concept clarity, easily you can clear the exam. But for this, you don't have to read the things only. You have to practice, you have to revision on daily basis. So, we will revise every unit with the help of MCQs, PYQs and everything, and we will learn everything in the deepest manner, right? So the Forex business or foreign exchange market is the global decentralized marketplace for exchanging the national currencies, and it is the world's largest and most liquid financial market, right? And you can say that here participants range from large banks and corporations to individual retail traders. They are engaging in the currency conversion for practical reasons to speculate on price movements for the profit, right? So what is the meaning of this foreign exchange? Means exchange of one currency into another's country currency, that is called the foreign exchange, right? So like rupees 83 is equals to 1 US dollar, right? 1 US dollar is equals to rupees 83. So whenever an Indian importer buys the dollars to pay the US supplier, it is a foreign exchange transaction. That is called Forex exchange transaction, or you can say that this is also, you can say FX. This is the shortest name of foreign exchange market. So foreign exchange of one currency, one country currencies into another country's currency. Foreign exchange market. This is the market where foreign currencies are bought and sold. This is the market where foreign currencies are bought and sold. It is a 24-hour market. It works across in different time zones in Asia, Europe, USA, Dubai. Over the counter market, no physical exchange is there like stock market. Operates through banks, financial institutions, dealers and brokers. So US dollar INR trading in Mumbai. Euro US dollar trading in London, Japanese yen US dollar trading in Tokyo. So one market closes, another opens. That is the foreign exchange market, and it is 24 into 5 days market. Saturday, Sunday is off here, right? Then what is the importance of this forex market? Why this is one of the sector which is growing too much? What is the importance of this forex market? See, in importance, we can say that first thing, that is 24 into 7 market, highly liquid, and here you can say that any type of buyer available, right? And forex market plays very important role in the international trade, right? In the international trade, it imports, here the importers, obviously they need foreign currency, right? Importers need foreign currency. Also, exporters here receives the foreign currency. And here are the flow of funds is quite good. Foreign investments are there. Remittances are there. And apart from this, you can say external borrowing are there. Economic growth is there. It supports the globalization. And it also facilitates international payments. That's why this foreign market is very important, right? So I hope that this is clear. What is exchange rate, what is forex business, and what is the meaning of this, what is the importance of forex market. Now, Indian foreign exchange market, let's learn about Indian foreign exchange market. Indian forex market has developed strongly. Why? Just because of three things. First is liberalization, globalization, and also privatization. Privatization, here first if I tell you about the liberalization, because three terms, these three terms are very common, but we have to know the meaning of liberalization is the process of reducing or eliminating government regulations and restrictions on the economic activities. It allows greater private sector and foreign participation. It includes like deregulation of industries, easing of trade and investment policies, and the globalization. Globalization is very important. Why? Because in globalization, it increases the interconnectedness of economies, cultures, societies, which are at the worldwide level, driven by trade, technology, and the flow of information, right? And what is the meaning of privatization? Privatization, you can say that is the concept, is the process of transferring the ownership, control, or management of a public sector entity to the private sector. Essentially shifting from government hands to the private hands. Obviously, it will lead to increase efficiency and reduce government burden and also introduce market forces, right? So that is three things. So what are the key points here? It is completely regulated by the RBI. Bank are act as authorized dealers here, and market practices, these are aligned with the global standards, right? So that's why Indian forex market is strongly developed. So dealing room operations, what is dealing room operations? This is the heart of the bank's forex operations. Heart of the bank's forex operation. Why? Because it is also called profit center of the bank. Why? Buying and selling foreign currency is happen here. It helps in managing the risk. It also quotes the exchange rates. It ensures that everything is according to the RBI and FEDI rules. And why the control is important? Why that control is important here? Because large volume is available here, high risk is available, 24 hours operation is available. So with the help of proper management, control and the guidelines, it ensures obviously a good and entire order type of market. That's why control is necessary. And we know that if we managing something at a big level, we need control, right? So first here, exchange rate, whatever the price of one currency in terms of another currency, that is called the exchange rate. Price of one currency in terms of another currency. Like example, US dollar INR is equals to 83.20. That means 1 US dollar is equals to 83.20. This is very simple arithmetic expression of the value, right? Value date, when the actual settlement happens after the deal. That is the date, actual real date when the settlement happen. So basically we have different types of deal. In cash deal, which is called immediate basis, like everything happens on the same day. Term, next working day, means the deal is done today and the settlement happens tomorrow, if there is no holiday available, right? Then we have spot, 2 working days, means if deal is happening today, then the settlement will happen after the 2 days, after the 2 business days, right? So that is called spot. So if trade date is Monday, so in spot value date is Wednesday. That is called the value date, right? Now we have authorized persons. What is the meaning of these authorized persons? Authorized persons, these are the entities who got permission by the RBI to deal in the foreign exchange. They deal in foreign exchange. They got the license from the RBI to deal in the foreign exchange. So it includes what? It includes authorized dealer banks and money changers, as well as financial institutions. Right? You cannot buy directly US dollar from RBI. You have to buy it from the authorized dealer. Right? Then we have OTC market. What is the OTC market? That is over the counter. Over the counter means Forex market is an OTC market completely, because there is no centralized exchange available. Transactions happen directly between the parties. Deal done through the phone electronic system. So you can say that if a bank is in there in the India, it directly deals with the bank in London, just because this market is completely the over the counter, right? Cross rate, what is the meaning of cross rate? Very important questions are there. Cross rate is the exchange rate of two currencies which are not directly quoted, because that is not available, but with the help of cross rate it is useful calculated using a third currency. Example, if suppose US dollar INR is 83 given, Euro US dollar is 1.10, you have to find Euro INR and it is not available, but with the cross rate mechanism, with the help of cross rate mechanism, you can find Euro INR. How? That 1.10 is multiplied by this 83, you got 91.30. So Euro INR is equals to rupees 91.30. That is the cross rate. And so many numericals are there on this cross rate. You must know how to find the third currency if the direct quote is not available. And the most important, FEDI, which is a self-regulatory organization, and it is established in 1958. What is the full form of FEDI? Foreign Exchange Dealers Association of India. Foreign Exchange Dealer Association of India. It sets market practices, it provides guidelines, it standardizes Forex operations in the India, right? So lots of things are done by this FEDI. And one more thing, example, you can say it, they basically give the rules for the forward contracts, for cancellation, for delivery procedures. So FEDI is one of the most important organization which provide guidelines how to deal, how to do the things in the foreign exchange market, right? Now we have here FEDI. Then we will learn about the forward contract. What is the meaning of forward contract? It is a binding agreement. Binding agreement to buy or sell a foreign currency at a fixed rate. Right? Example, suppose if any importer is there who books US dollar 1 lakh at 83 rupees 5.50 for 3 months. Now, even the rate becomes 85. Bank have to sell it only at 83.50. That is called the forward contract. Suppose if two persons who are worrying about the future rates, so what they will do a contract, buyer and seller, they will do a contract today on today's rate, and the settlement happens after 30 days or whatever the contract is saying. And after 30 days or after the time whatever is mentioned in the contract, they have to do the settlement according to the price they fixed earlier. That is the concept of forward contract. Is that clear? That what is forward contract? Okay. Now what is premium and discount? Premium or discount arises due to interest rate difference between the two countries. Suppose if a premium, what is premium? It is if a currency is at premium when it commands more units of another currency in the future. Example, if two persons do a forward contract and there the spot price is 83 rupees. They do a agreement on 83 rupees. But after 3 months, that rate become 83.50. So obviously that 50.50 is the benefit for one party. So that means US dollar is premium because future prices is higher. Right? And what is discount? When discount is basically currency is at discount when it commands fewer units in the future. If the rate is 83 and in future it become 82.70, so that we can say US dollar is at discount. So what we learn up till now, Forex market is a 24-hour OTC market. Exchange rate, that is the price of one currency in another. Value date is the settlement date. Cross rate is the derived rate which we have to calculate. Forward contract is future purchase or sale. Premium or discount, that is interest rate differential. FEDI regulates the market practices in the India, and dealing room control is critical due to high risk. Right? So in this chapter, basically daily we will revise the chapters just in a short way, because in one day we can't complete the complete chapter in just 1 hour. So we have to do the chapters, the important things, all the important terms. Apart from this, if you need any type of help, just do the comment and let me know, so I will help you. Right? Okay. What is swap? It is an agreement. It is an agreement where two parties exchange specific streams of payment or their cash flows over an agreed period of time. Swap is an agreement where two parties exchange specific streams of payment over an agreed period of time. Instead of one single payment, multiple payments are exchanged over the time. Right? Multiple here things are exchanged over a time. Okay. Example, if bank A gives interest payment, bank B gives INR interest payment, they continue the exchange for just a fixed period. That is the meaning of swap. Or in easy words, you can just, this is a derivative product. So what is the meaning of swap? In simple words, you can just learn this is a financial contract in which two parties, they are agree to exchange the cash flows or liabilities from two different financial instruments over a specified period. And these contracts are primarily used to manage or hedge against financial risk, such as interest rate and currency fluctuations, rather than for speculation by retail investors. Right? Is that clear? Now, let's learn about fixed exchange rate. It is the official rate which are fixed by the monetary authorities like RBI or the central bank. If RBI declares that $1 is equals to 75 rupees, that is fixed, market participants have to follow this rate. Floating exchange rate, as the name is floating, it is decided by whatever the market forces of demand and supply. More demand for US dollar become expensive. Less demand, US dollar become cheaper. So India follows a managed floating exchange rate system. Right? Then we have the most important thing is there, the direct exchange rate. Direct exchange rate. What is the meaning of direct exchange rate? See, direct exchange rate basically when the exchange rates are expressed in terms of home currency. When the exchange rate expressed in the terms of home currency. Example, if US dollar INR is equals to 83, right? That means 83 rupees for 1 US dollar. This is the example of direct exchange rate. But parallelly, what is the meaning of indirect exchange rate? Indirect exchange rate, when exchange rate expressed in the terms of foreign currency. Example, you can say if INR US dollar is equals to 0.012, that means 1 rupee is equals to 0.012 US dollar. That is the example of indirect quote for the India. Is that clear or any problem? I hope the things are clear. So if you like this session, kindly give the like, that is important, and also do the comment if any problem is there. Okay, now we will learn about ready or cash rate. It is a type of deal which is immediate basis, which happens on the immediate basis, where the transactions settled on the same day. It is called value today. Today deal, today settlement. Deal to happen today, so the settlement will be happen today. Right? Tom rate, tomorrow rate, transaction settled on the next working day. So deal on Monday, settlement happens on Tuesday. Why Tuesday? Because Saturday, Sunday is off. Right? Just wait. Here Monday, settlement on Tuesday. Suppose if settlement is done on Friday, so deal is done on Friday, then in that case Saturday, Sunday is off, so settlement will happen on Monday. And if any holiday is there, sudden holiday, then also the next business day settlement will happen. Generally the meaning of Tom deal is just the settlement will take place on the very next day. Spot rate, where the transaction settled on the second working day from the date of transaction. If deal is there on Monday, settlement will done on the Wednesday. Most of the popular deal in India and Forex transaction. Forward rate, when exchange rate for the settlement beyond spot date, any day of settlement apart from the spot date. Right? In this, basically settlement happens after 1 month, 3 months, and it is usually used mainly why? Just for hedging the future risk. Right? Then we have here the thing which is foreign exchange risk. What is the meaning of foreign exchange risk? Foreign exchange risk of loss due to the adverse movement in the exchange rates when a bank opens a position in foreign currency. And you know that exchange rates are fluctuates in every 4 seconds, 21,600 times a day. So foreign exchange risk is the risk due to the adverse movement in exchange rate when a bank has an open position in foreign currency. Suppose if a bank buys US dollar at 83 rupees and rate falls to 82, so obviously bank will suffer loss, right? Then what is the meaning of transaction exposure? Transaction exposure. See, when the risk arises due to the exchange rate changes between the transaction date and settlement date. When the risk arises due to exchange rate changes between the transaction date and settlement date. Example, suppose any exporter is there who invoices US dollar today, right, and receives the payment after the 3 months. So if US dollar depreciate, exporter loses the money. That is called the transaction exposure. And the same term is there, that is called translation exposure. What is the meaning of translation exposure? Risk arising when the foreign currency assets and liabilities at the end of the accounting year. Risk arising when valuing the foreign currency assets and liabilities at the end of accounting year. Means assets and liabilities mature in future, so they revaluate at the current exchange rate. Example, you can say foreign branch assets converted into the INR for the balance sheet. That is called the translation exposure. Is that clear? Okay, so that is translation exposure. Now we have operating economic exposure. Means how the future cash flows and profit are affected by the unexpected exchange rate changes. So if INR appreciate, export become expensive. Profit may fall in future. So this is a long term exposure. Open position. What is the open position? Open position is the difference between the assets on whatever we purchase the contract and the liabilities and the sale contract. The difference of these is called the open position. If a bank buys more US dollar, then it sells. That is the long position. If the bank sells more US dollar, then it buys. It is a short position. Right? So these are the important terms. When we solve numericals, this will help us. That what is the open position, long position, short position, overnight position. Obviously, maximum open positions allowed to carry forward only for a night in a major currencies, because it controls the risk and it avoids the losses due to the overnight rate changes. What is the meaning of daylight position? When the maximum open position allowed during the trading day. Basically here are the limits are higher than the overnight limits and it must be squared off before the day end, right? These are squared off. And then we have very important one derivative which is called options. So what is the meaning of option? When a forex option, when a forex option gives the holder the right but not the obligation, to buy or sell a currency at a fixed price on future date. When a forex option gives the holder the right but not the obligation to buy or sell a currency at a fixed price on the future date, right? And here the loss is limited but profit potential is unlimited, right? So in this we have one thing which is called call option. What is the meaning of call option? Where there is the right to buy a currency at agreed price. Where right to buy a currency at a agreed price. So importer buys call option to buy the US dollar at 83 rupees. And what is the meaning of put option? Where right to sell a currency at a agreed price, right? So example we can take, exporter buys put options to sell US dollar at rupees 83. So what we learn here up till now, first let's learn about the future. These are the standardized forward contract which are traded on exchange. These are fixed in size, maturity fixed, exchange are regulated and settlement happens daily. And like future currency futures on the NSE. What is the meaning of currency swaps? Currency swaps. Currency swap, we can say that it is a type of financial agreement where two parties exchange principal and interest payment in the different currencies, and it often to lower the borrowing cost or hedge against exchange rate risk. And it also allows companies to access cheaper foreign capital market or manage the international debt. Basically, so you can say that agreement where two parties exchange principal and interest payment in the different currencies. If company A gives US dollar, company B gives INR. So payment exchange over the time. And what is the meaning of interest rate swap? Where the exchange of interest payment streams of the different types. Means you can say in the interest rate swaps are those financial derivatives where two parties they exchange the stream of interest payment. They swap fixed rate for a floating rate, right? Example, one party pays fixed interest, other party pays the floating interest. There is no exchange of principal. So what we learn up till now? Swap, where the exchange of payment streams happen. Fixed rate are decided by authority. Floating rate are decided by the market factors, right? And spot is T plus 2 settlement, means settlement happens after the 2 days. What is forward? Which is beyond the spot. Transaction exposure is for the short term. Translation exposure is having the accounting impact. Operating exposure is a long term effect. Call means right to buy. Put option means right to sell. And futures are the standardized forwards. Right? Now, the first question is there. If 1 US dollar is equals to 68.10 rupees, so what is the exchange rate for 1 US dollar? See, 1 US dollar is equals to 68.10 rupees, right? So this statement itself defines the exchange rate. Exchange rate is what? That tells us how much of one currency is required to obtain 1 unit of another currency. So how many Indian rupees are needed to buy 1 US dollar? 68.10. Right? So the correct answer is here option A, 68.10 Indian rupees. Is that clear? Now the next question. What conditions must be met for settlement in the forex market when dealing with holidays in different countries? What type of the conditions must be met for the settlement in the forex market when dealing with holidays in the different countries? Very simple. When two countries they exchange money in the forex market, the payment happen only when banks are open in both countries, right? And why these holidays matter? Because every country having their own holidays according to their culture and according to their work. If there is if any one country is on holiday, so obviously banks there are closed, and if banks are closed, that means no bank transfer, no money transfer, right? So settlement cannot happen on a holiday. If the normal settlement date falls on holiday in any one country, so the deal is settled on the next day when the both countries are working. This day is called the next common working day. So the correct answer is here. The settlement date should be the next common working day in both of the countries. Option C is correct. Clear? What does the term nostro account refer to banking? Nostro account. What does the term nostro account refer to the banking? See, very simple explanation I am giving you. What is the meaning of this nostro account? Nostro account means our account in the foreign bank. Our account in the foreign bank. How to remember? Nostro when our account is foreign bank. Vostro when the your account is there. And what is loro? When their account is. Right? So nostro account, our money kept with the foreign bank. So here the meaning of nostro is our account with a foreign bank. Option A is correct. Next question. When arbitrage involves three or more centers and multiple currencies, what is it referred to as? Arbitrage. What is arbitrage? Suppose in one market rates are very low. So what arbitrators do? They purchase the currencies from this lower market and sells to the another market where the rates are high. So that difference of these high and low is called the profit for the arbitrators. So when they are involved in two or more currencies, what it referred to as? Basically uses money, then one currency, more than one currency. Money is moved through three currencies. So this type of arbitrage is called compound arbitrage or 3-point arbitrage. Or also you can say triangular arbitrage. Right? Direct arbitrage where only two markets and one currency pair is there. Simple arbitrage, basic form, no multi-currency is there. Indirect arbitrage where uses the cross rates but not full 3-point arbitrage. So three currencies, 3-point arbitrage. So the answer C is correct here. Clear? Next question. In the currency pair, if US dollar INR is equals to rupees 68.1011 per US dollar, which is the buying rate and what is the selling rate? Very good question. Very basic question. So tell me the answer. Very simple. Because I think that if you are doing any thing, so you need the concepts in a very from the zero level, right? So here you can say very simple 68.10, this is the buying rate, and 68.11, this is the selling rate, right? First rate is the buying rate always, which is also called bid rate. Second rate is called selling rate, which is called ask rate. Buying rate when the bank buys US dollar from the customer at 68.10. Selling rate when the bank sells US dollar to the customer at 68.10. So bank always buy cheap and sell costly. So that's why buying rate is smaller than selling rate. So the correct answer is here option A. Next question. What is the buying rate in the currency exchange transaction? Very simple answer. In a currency exchange transaction, the buying rate is rate that which the bank buys foreign currency from the customer. Right? The rate at which the bank buys the foreign currency. Which type of exchange rate is set by monetary authority and usually pegged to one or more currencies? A fixed exchange rate is the rate that is decided by the monetary authority like RBI, and it is pegged, means linked to one currency or a group of currencies. So government or central bank controls the rate instead of leaving it to the market. So the correct answer is fixed exchange rate. In a floating exchange rate system, how is the value of exchange rate determined? How is the value of exchange rate is determined? What is floating exchange rate? Obviously, where the value of one currency is not fixed, value of the currency is not fixed, right? And it changes constantly in the market. Central bank does not fix it. The rate is determined by how much people want to buy or sell, right? So you can say by the supply and demand factors of that particular currency, the value of exchange rate is determined. Clear? Is that clear? Now, next question. When did India switch to the floating exchange rate system? When did the India switch to the floating rate system? India used a fixed rate system before 1991, but after the economic liberalization in 1991, India gradually moved to a market determined rate. And officially by the 1993, India adopted a floating exchange rate system where the rupee value is determined by demand and supply in the market. So the correct answer is here option B. What is simple or direct arbitrage of Forex? I already told you, simple means you buy a currency in one market where it is cheaper or sell it another market where it is more expensive to just earn the profit. It is called direct because it involves only one currency pair and two centers in the market, right? So buying the one currency in one center and selling it to the another center for a profit is the correct answer. What is the primary difference between a ready cash and a term rate in forex settlement? See, this first question, second question, very easy. Third question, fourth question, and this one is fifth, and this one is 5 questions. These 5 questions you have to tell me in the comment section if you know these. All the 5 questions. You have to tell me in the comment section the answer, and this is the homework of today's class. You have to attempt these 5 questions and give me the answers in the comment section. So it is Unit 2, Liberalized Remittance Scheme and other remittance facilities for the residents. I hope that I am audible. My screen is visible. Let me check the audibility, then we can start our class. So today we are going to start this LRS, a very important chapter with some questions and numericals. So let's start with the class. Liberalized remittance scheme. If I give you the overview of the liberalized remittance scheme, this is implemented by Reserve Bank of India under the FEMA 1999, which allows the resident individuals they can remit up to US dollar 2,50,000 per financial year, April to March, for various permitted current account and capital account transactions. Right, and here it is available for the resident individuals, including minors, but not to the entities like corporates or the trust. And what is the annual limit? US dollar 2,50,000 per individual applies, regardless of the number of transactions. Right. So we will learn some more concepts to regarding this chapter. So let's start with the class. LRS. LRS, which allows a resident individual in India to send the money abroad up to US dollar 2,50,000 per financial year for the permitted purposes. This limit is overall. It includes all foreign remittances that made in that year. Okay, so means only US dollar 2,50,000 remittance is allowed. Example, if Mr. A sends US dollar 50,000 for son's education, then it is okay. US dollar 30,000 for travel, allowed. US dollar 20,000 for investment in the US shares, allowed. So total is US dollar 1 lakh. He can still remit US dollar 1,50,000 more in the same financial year, right? In the same financial year, he can still remit US dollar 1,50,000 uh, to in the same financial year. Got it? Okay. Now, here we can say that that is okay. We know the limit now. That what are the permissible and what are the non-permissible remittances? Permissible versus non-permissible remittances, because all type of remittances are not allowed, right? So in this we can include the permissible remittances. These come under the schedule third of the FEMA. Schedule third of the FEMA, right? And in this we can include education abroad, medical treatment abroad, travel, and maintenance of close relatives abroad. And you can include in this gift, donations, right? These all are the permissible remittances. Purchase of the property abroad, investment in the foreign shares, mutual funds, companies, opening the foreign bank accounts, these all are available. These all are allowed. Mr. B remits US dollar 40,000 to buy an apartment in Dubai. That is permissible. That type of transaction is permissible. Got it? So we can say that what are the permissible and non-permissible remittances? According to the schedule third of the FEMA, some are the permissible and some are not the permissible. And what are the non-permissible remittances? These are not allowed under the FEMA, such as uh, lottery tickets, sweepstakes, margin trading, remittances to countries which are identified as high risk, prohibited activities under the Indian law. If Mr. C wants to send money and participate in overseas online lottery, that is not allowed under the LRS, and this is non-permissible remittance under the schedule first of the FEMA. Clear? So if anybody wants to take the lottery ticket, that is not allowed. FEMA. What is the meaning of FEMA? Foreign Exchange Management Act 1999, which which give direction, which provides guidelines to all the foreign exchange transactions in the India. It replaced FERA because FERA is little bit complicated and strict regulation, and it shifted the focus from criminal punishment to civil compliance. Earlier mistakes were treated like crimes. Now they are treated as violation, but violations with the penalties, right? But now these are treated as violation, but with the penalties. Clear? here we can say that the FEMA is now giving directions with the civil compliance. So if any person violates any FEMA rule, he may have to pay a penalty, not go to the jail, unless the serious offense is not there, right? And what are the KYC requirements? Before allowing any type of remittance, any type of money sending abroad, the authorized dealers, which we already discussed in the previous class, who have the license from the RBI to deal in the foreign exchange transactions. Now, authorized dealer bank, they have to complete all the KYC of the remitter who is sending money, including minors also. KYC includes identity proof, address proof, PAN card, source of funds declaration. If parents remit money for a child education abroad who is minor, the bank will check parent's PAN card, bank account detail, and from where the income is coming. So these are the KYC requirements under the uh, LRS. Clear? Now, what is the meaning of capital account transaction? Very simple thing. Those transactions who changes the assets and liabilities of the individual in abroad, who alters those transactions, who alters the assets and liabilities outside India of the residents who are in the India, or of the NRIs, uh, assets and liabilities are changed in India. Meaning, if suppose Mr. X is living in, right, and Mr. X assets or liabilities changed in America. So that transaction is capital account transaction. And if any person, Alex, who is living in India and is a citizen of the America, and in India, Alex assets and liabilities are changed. So that is also considered as capital account transaction. Investing in shares of foreign company, that means it creates an asset abroad. Buying property abroad means ownership of property abroad is an asset. So capital account is long-term investment and the asset creation. So we have to keep this thing in mind. Whenever we say what is capital account transaction, that alters or changes the asset and liabilities of an individual outside India and alters the asset and liabilities of the NRIs who are in the India. Clear? That is called capital account transactions. Right? Now, second thing we have current account transaction. What is the meaning of current account transaction? Any transactions other than capital account transaction. Any transaction other than capital account transaction is called current account transaction, which includes trade payment, interest on loans, income from investment, travel, education, medication, gifts, family maintenance expenses, everything. Parent sending money to a child who is studying abroad. That is called current account transaction. Current account transaction, day-to-day expenses and the payment. That is called current account transaction. Clear? Now, I hope that clear what is current account and what is capital account. Now, what are the key sections of FEMA? Important. First one, section 4 is saying if anybody holding the foreign exchange, that is a violation of the FEMA. Resident, they are not allowed to hold any type of foreign currency, securities or property abroad unless it was acquired while being a non-resident. If someone is in America and uh, that person is qualifies as NRI for the India, and at that time that person purchased any property or any foreign currency or any security, then it is okay. But apart from this, no residents are allowed to hold foreign currency, foreign security, property abroad. Residents can invest abroad in the property or equity, but they have to follow the guidelines of the RBI and all the LRS rules. That is by the section 4 of the FEMA. What section 6 saying? Only authorized persons are liable to buy or sell the foreign exchange for capital account transaction. Only the authorized persons. Residents, they can't directly trade foreign currency for the purposes. They have to follow and guidelines prescribed by the RBI. Then we have section 10 subsection 6. Foreign exchange purchased for a specific purpose. That means that person have to use the foreign exchange only for that purpose. That does not mean if I purchased foreign exchange just for sending my family in abroad and I invest in some other place. That is not allowed. That is a violation of the FEMA. If foreign exchange is purchased, that must be used only for that purpose. If it is not used within the specified period, used for any other purpose which is not allowed, that all are considered as the contravention of the FEMA. That all are allowed as that all are called as the contravention or violation of the FEMA. Then we have section 11. Powers of the RBI. What RBI can do? RBI can direct the authorized person that you have to follow the rules of the FEMA. Authorized persons have to follow the rules of the FEMA. They can acquire authorized person, submit the information. I need the information. And also penalties is there. If any authorized person is not following the rules and regulations, they have to pay the fine of rupees 10,000 and 2,000 per day if the violation still continues. So RBI also checks all the authorized dealers whether they are following their responsibilities or not, whether they are doing their business, foreign exchange business properly or not. That is basically the section 11 say of the tells about the power of the RBI. Right? Then what are the section 13 is saying? Penalties. What are the penalties for the contravention? Authorized dealer fine, we know that. Now, what is the fine of the contravention? If a person violates the FEMA rules, penalties are up to 3 times the amount involved if the amount is quantifiable. Suppose if any person do a contravention of 2 lakh, 3 times of 2 lakh is 6 lakh. And if amount is not quantifiable, measurable, in that case 2 lakh is the fine, and continuing violation additional 5,000 per day. So strict penalties still exist for breaking the FEMA rules. Right? Is that clear? All the rules and regulation. Now, sources of funds declaration. Source of funds declaration means the remitter have to declare that what are the sources of funds. What are the sources of the funds? The bank must be satisfied that the source is genuine. The source is genuine. If Mr. D sends US dollar 1 lakh, he may declare that the source is selling of residential property in India, because bank can ask for the sale deed as well as bank credit entry. Right? So banks check that thing, what are the actual source of the funds declaration. Then funds in, funds out monitoring. Funds in, funds out monitoring, that in this bank, authorized dealers bank, they check what are the credit, what are the debit in the account over previous periods. They ensure that there is no suspicious activity. They ensure everything is according to the rules and regulation, and also the most important guidelines, anti money laundering guidelines. Suppose if suddenly large cash deposits are seen before remittance, so obviously the bank may question why sudden cash, what is the source, and in that case, the remitter have to prove the source of funds, right? Then for high value remittances, banks do a second level check also. This is an additional control just to prevent the misuse. If the threshold is 50 lakh and customer request 80 lakh remittance, the transaction will go through branch check, then compliance on risk team check, right? So bank will ask that what are the actual source, right? Now here let's learn about post facto monitoring. Even after the remittance, bank monitor whether the required documents are submitted, whether the regulatory reporting is completed, whether the capital account transactions are properly reported to the RBI. If money is sent for investment abroad, the bank will later check is the APRS is filed annual report, whether investment details are submitted or not. And what is FATF? Financial Action Task Force. It is an international body that fights about for money laundering, that fights for terrorist financing. Countries are rated based on the compliance. If a country is on FATF blacklist, Indian banks will either restrict or closely monitor transactions to that country. And PMLA, most important thing is here, PMLA. What is the meaning of PMLA? Prevention of Money Laundering Act 2002. It aims in preventing money laundering, right? And also it also confiscate the property which are derived from illegal sources, and it is effective from 1st of July 2005. If someone sends money abroad which are generated from illegal activities, it can be investigated, obviously, and also property can be attached by the authorities, right? And who are the close relatives? As per the Companies Act, who are the close relatives? As per the Companies Act 2013. So let me tell you about the close relatives. A close relative is member of HUF, husband and wife, um, relations like parents, children, siblings, these all are come under the close relatives definition. Clear? Now, ODI, overseas direct investment. Obviously, if I'm investing in equity capital of a foreign entity, of a foreign country, that is called ODI, right? If an Indian resident buys 20% shares in UK company, this is ODI. What is the meaning of EFC account? EFC is a foreign currency account for the exporters and the persons who are earning the foreign currency, in which they use this account to hold the foreign currency earnings without converting to the INR, right? Without converting to the INR. So here, an exporter receives US dollar 10,000 from a US client and keeps it in the EEFC account. That account is work only for these purposes. Now we have RFC account. What is the meaning of RFC account? It is basically resident foreign currency account. Resident foreign currency account. This is the account for the returning NRIs who again become Indian or who again become residents again. These uh, used for this is used for holding the foreign currency assets, right? So what is the meaning of APRS? APRS is annual performance report. Annual performance report, right? Annual performance report must be submitted to the RBI bank through the authorized dealer by 31st of December every year 31st of December, right? It reports performance of the overseas entity where the investment is made. It also reports profit, turnover, net worth, everything, right? So that is the meaning of APRS. Is that clear? Now, most important, TCS, new TCS rates are there. If the education purpose is there, if education is financed by loan, then in that case, no TCS will apply. But if medical treatment or education is not financed by loan, then in that case, no tax up to 10 lakh, but exceeding 10 lakh, 5% tax is applied. TCS is applied. Then for other purposes, no tax up to 10 lakh, but above 10 lakh, 20% TCS is applied, right? And in overseas tour package, 5% till 10 lakh and 20% thereafter. And 20% is the maximum rate. These rates are effective from 1st of April 2025. Clear? The numerical questions will be there from only these slides. You can get the numerical questions. Is that clear? If any problem is there, you can ask me. That there is no problem. I think the things are clear. Everything is clear to you. Okay. Now, let's move to the questions where we will do some numericals and some study-based question. Can a resident individual gift foreign currency or foreign securities for the credit of another resident foreign currency account which held abroad under the scheme? Can a resident individual gift the foreign currency for the credit of another resident foreign currency account abroad under the scheme? So the clear answer is there in two words, that is a big no. This is not allowed. Under the LRS, a resident individual They may remit the funds for the permissible current and capital account transaction, including gifts also. But a resident individual is generally not permitted to hold a foreign currency account abroad, except unless specific RBI permissions are there. Gifts under LRS are typically structured as remittances to non-resident for or for use in India, not to fund another resident overseas account. So such type of gifts are completely not allowed. Next question. In the going abroad for employment, how much foreign exchange can person withdraw per financial year from authorized dealers in the India? Yes, the limit is US dollar 2,50,000. Under the LRS, a person going abroad for employment can take up to US dollar 2,50,000 in one financial year from an authorized dealer bank in India. Right? This limit is same for studying abroad, employment abroad, travel, gifts, maintenance of relatives. So the maximum of US dollar 2,50,000 is allowed here. Next question. What does IFSC stands here? IFSC in financial services. IFSC is International Financial Service Center. What is it? It is a designated area in the India, such as Gift City in the Gujarat, where financial services are provided to non-resident and the overseas market, which is similar to the global financial hubs like Dubai or Singapore. IFSC is a hub where financial services are provided to the non-resident and overseas market. Clear? Then first do this question. Yeah, this is the numerical. Mr. Ajay, who is studying in a university of USA, and he has availed a loan of 10 lakh rupees from a bank. He wants to remit the amount to US for his study. So how much TCS will be paid by him on his transaction if his PAN card and Aadhaar card is available? So if you know the answer, kindly give the answer in the chat box. How much TCS will be deducted here? So what I told you, the answer is here nil. Why nil? Because he availed a loan of 10 lakh rupees when the education is financed by the loan. When the education is financed by the loan, no TCS is applied here. So the answer is nil. We have to write nil, no zero, nil. Next question. Mr. Mohan, who is studying in USA and he has 25 lakh rupees in his saving account. He wants to remit 15 lakh rupees to US for his study. So how much TCS will be paid by him on this transaction? Yes, Shailendra sir, you have to write in that case nil, no zero. If answer is zero, then we have to write zero. But in that condition, nil, no tax is applied. That's why we have to mark the answer nil. So, come 15 lakh up to 15 lakh, up to 10 lakh is taxable. Sorry, is exempted. 5 lakh is there. Now on this 5 lakh, we have to apply how much percent? 10, sorry, 5%. Sorry, we have to apply 10% on this 5 lakh, right? 5%. 5% here, and the answer is the 10,000. 5 lakh, sorry, 25,000. Sorry, I confused here. 5% of 5 lakh is 25,000. 10 lakh is exempted up to 10 lakh. the leftover amount is 5% and 5% tax is deducted. That the answer is 25,000 is deducted. Next question. Mrs. Shanti is sick and she wants to visit US for his treatment. She transferred 12 lakh to hospital for his treatment. How much TCS will he paid by her on his transaction? Yeah, 25,000 is correct. What is the answer in that case? Very simple. 10 lakh is exempted. So 2 lakh, we have to deduct 5% on this 2 lakh. The answer is here only 10,000. How much TCS is? 10,000. Great. Next question. Miss Geeta study in a university of USA and she has availed a loan of 12 lakh rupees from a bank. And she wants to ram it. How much TCS? And her PAN card, Aadhaar card is not available. Her PAN card and Aadhaar card is not available. See, LRS for the education purpose, if the amount being is remitted is from education loan obtained from a specified institution, whether the amount is 10 lakh or above 10 lakh. In the case of operative PAN or non-operative PAN, if the PAN card, Aadhaar card is there or not there, still there will be nil taxes there. No TCS will be there because she availed a loan. That's why no TCS is there, right? But if he not availed any type of loan, then 10% tax is deducted. Yeah, nil answer is correct. Next question. Miss Deepthi wants to send money to USA for remittance of her family. She wants to transfer 8 lakh. So obviously 8 lakh and 8 lakh is already below the 10 lakh. So obviously 0 rupees is deducted here. Here we have to write rupees 0, right? 0 rupees is deducted here. And the last question, uh, on last question of numerical is here that Mr. X wants to remit US dollar 15,000 for purchasing a property in USA. He therefore requests his bank to remit the amount by debit to his account. And on the date of remittance, the US dollar INR rate are as follows. TT buying rate is given. So what is the amount of TCS that the bank will deduct in order to make the said remittance of US dollar 15,000? See, how to solve this question? See, Mr. S has to make a payment of US dollar 15,000 here, right? Mr. X have to make a payment. So in this case, bank will sell, and what is the applicable TT selling rate will be here 86.55, right? And amount will be there US dollar 15,000 multiply 86.55, which is equals to here rupees 12,98,250. Right? Now we have to deduct the tax. How much? 10 lakh. Up to 10 lakh is exempted. So 2,98,250. And on this, we have to apply 20% of tax. And 20% of tax. And how much it is equal to? 59,650. The answer is 59,650. So 20% we have to remit because this is 20% we have to deduct because in this case he's remitting the money. Clear? So what is the minimum maturity period of loan given by resident individual to NRI PIU close relatives? See, under the LRS and the RBI regulation, a resident individual is permitted to grant the loans to the NRIs and PIOs close relative. But such type of loans must be interest free and must have a maturity period of 1 year. The loan should be given by way of cross-border remittance through the banking channel. So the answer is here 1 year. Option B is correct. What does Section 11 of the FEMA Act 1999 empower the RBI to do? Section 11. We already talked about the Section 11. So Section 11 is giving the direction to the authorized person regarding the foreign exchange and the securities. It gives the directions to the authorized person regarding foreign exchange and securities because under the section 11 of the FEMA 1999, RBI is empowered to issue directions to the authorized persons like regarding the dealing in foreign exchange or foreign securities. And this is also the main tool for the RBI to regulate foreign exchange operations in the India. So the correct answer is here option C. And what is section 4 of the FEMA Act 1999 primarily concerned with? Holding of foreign exchange by the resident individuals. Means restrictions and permissions regarding the possession, ownership, holding of foreign exchange by the resident individual in India, Section 4 dealing with it. It ensures the resident can hold foreign currency only permitted under FEMA rules such as through the LRS or other RBI approved channels. Clear? What kind of penalty can RBI impose on authorized persons for non-compliance with its direction under the Section 11?
So the answer is here a penalty of up to 10,000 and continuation. If violation is in their continuation, then 2,000 per day. Uh, According to the section 13 of the FEMA, if any authorized person fails to comply with the direction that are issued by the RBI, so RBI can impose penalty of maximum amount 10,000 per violation. Right? Now, what is the penalty imposed on a person? If person do any type of contravention, then in that case, thrice the amount involved in the contravention plus 5,000 per day if the violation continues. In Schedule 1 of the liberalized remittance scheme, which of the following remittances are not permitted? Which of the following remittances are not permitted? See, the answer is here. Which of the correct answer is there? Purchase of the foreign currency convertible issued by the Indian companies abroad. Now, under which schedule of the LRS are remittances subject to approval for the respective government department and ministries? The one and only answer is Schedule 2. Why Schedule 2nd? Because Schedule 1, Schedule 1 permits remittances without prior approval because limits are mentioned. Subject Schedule 2, it covers the remittances that require prior approval from the RBI or the respective government department ministries. So answer is here Schedule 2, option B is correct. Third unit, correspondent banking and NRI accounts, where we will learn this concept in very deep and easy manner with lots of example that will help you to understand about this chapter. And if you have any problem in between, you can do comment. And if you are watching it in another time, so you can also ask your doubts. So let's start with the class. And if I give you the overview of the correspondent banking, that what is the meaning of correspondent banking? Correspondent banking means this is a system where one bank, that is correspondent bank, provides services like payment, currency exchange, trade finance to another bank. That another bank is called respondent bank, which is in the different country. That bank act as an intermediary to facilitate the international transaction without needing physical branches everywhere. Because we know that it is impossible to open the branches everywhere due to because it is expensive, right? And also, I think I'm audible. Just a second. Okay. So it is a little bit expensive to open the branches everywhere. And also, some countries are not allowing every bank to open the branch. So it is politically impossible, right? So, correspondent banking is that concept which basically facilitate international transaction without needing the physical branch everywhere. So it introduces risk like money laundering that require obviously strict AML KYC checks. It is very crucial for the global finance as well as it allows the bank offer the services in foreign market by using established networks, right? That is the concept of correspondent banking, overview of the correspondent banking. If we learn that first important thing, the important term, that is repatriable financial assets. What is the meaning of repatriable financial assets? are those assets that can be taken out of a foreign country, that can be brought back. In financial terms, you can use repatriated to the investor's home country, or if in foreign currency, it can be converted into the home country currency. In easy words, money or investment that you are allowed to send back to your home country are called repatriable financial assets. Those are allowed, you can send back to your home country, right? And what is the meaning of non-repatriable? See, non-repatriable. Non-repatriable, you can say, which you can't send. And why this repatriation matters? Because many people who live, work, and they invest outside their home country, right? They invest in apart from the home country. So in that case, government regulate whether you can take money out or not, how much you can take, in what form you can take, and if asset is repatriable, it means country allows you to take it to the back home in a legal manner. Legal manner. Country is allows you, right? Okay. If we understand this thing with the help of examples, let's understand the example. Suppose NRI salary is there. Okay, right? NRI salary. There is Ravi who works in UAE. Ravi who works in UAE and earns AED 10,000 per month, right? He sent part of his salary to the family which is in the India. Now, this salary is repatriable because it can be transferred to their Indian bank account, to his Indian bank account. It can be converted into the INR. This is repatriable case. Or we can take the example foreign investment. Let's take the example of foreign investment. In the case of foreign investment, suppose there is an Indian investor who buys the shares in the US company, right? An Indian investor buys the shares in a US company. Later, he sells those shares and got US dollar 50,000. If rule allow him, then he can send this US dollar 50,000 to India. It is repatriable. Or there he can convert it into the INR and use it in the India. And what are the repatriable asset? If an NRI invest in a special government scheme where money cannot be taken out of India, so that type of investment become non-repatriable. Now it is clear that what is repatriable and what are the non-repatriable, right? Now, so whatever the money can be sent back home, that is repatriable. Money must stay in that country, non-repatriable. Money is flexible, repatriable, restricted, non-repatriable. Money which are preferred by the NRIs, repatriable. Used for special scheme, non-repatriable. So why we need international banking? Because international banking help exporters or growing the economy. Financial transactions become smooth between the countries, whether it is belong to the remittance, trade payment, foreign investment, cultural exchange, anything, currency exchange. That's why international banking is important, right? So, what is the importance for the India? Like, what is here importance for the India? So, India has, we know that, a very large NRI population, right? Lots of people from India are NRIs. Millions of NRIs, millions of Indians, they are working in the Gulf nations, right? They are work in the Gulf nations like USA, UK, Canada, Australia, etc. So obviously they send the money to the India, right? They send money to the India for family expenses, for savings, for property purchase, for education, investment. These all are things called remittances. These all are called remittances. So why it is critical for the country? Because these NRI funds, these are the NRI's funds who are responsible to add the Forex reserves, right? It also strengthens the Indian rupee, and you can say it helps in balancing import and export. Also, it supports the economic development. So, in very easy words, we can say that when NRI sends money to India, the whole country benefits, not just their families. Got it? So, if NRI is there in Qatar who sends 50,000 rupees every month to his parents in Kerala, parents pay household expenses, money flows into the Indian economy, bank earn service charges, country earns foreign exchange. Same if there is an NRI in the Canada who opens their NRE account in India and deposits Canadian dollar 20,000. So bank use this money for lending. NRI earns interest, India gains foreign currency inflow. So that's why for India, these type of things are important. These types of transaction, these types of remittances are important. Clear? And if an NRI buys a flat in Bangalore and use money earning abroad, so obviously construction sector benefit, jobs are created, tax revenue is generated. So that international banking is that single concept that act as the financial bridge between Indian abroad and the India. Is that clear? Now, what is the meaning of correspondent banking? I told you it is an arrangement where one bank provides services on behalf of the another bank in different country or city. No bank can have branches in every country because obviously it is expensive and it is if we left the this leave the expensive thing, it is impossible because some countries are not allowing to open the branches and maintaining the account with thousands of bank is impractical. So bank use each other as agents. There are two meanings. Narrow meaning, two banks having account with each other. One bank has an account with the other. That is the narrow meaning. Apart from this, we can say broader meaning, even without maintaining account, banks work together. They handle the transaction. They provide services as the agents. So if we take the example of the foreign remittance, let's understand this correspondent banking concept. If there is a customer in the India, he wants to send the money to a person who is there in the Brazil, right? Now, his Indian bank does not have any branch in the Brazil. So, Indian bank uses the Brazilian bank as the correspondent, right? And Brazilian bank delivers the money to the recipient. Brazilian bank here charge a fee for the service. That is the concept of correspondent banking. So why this correspondent banking is needed? Because a bank cannot open branches everywhere. International trade and remittances must still happen. Customers expect seamless global services. So local banks, they act as representatives for the foreign banks, right? One more thing, one more thing we can say. If suppose there is an Indian exporter sells to the goods to the company, that company is in Germany, right? Now, German buyer pays through his local bank, and that bank uses the correspondent bank in the India, right? Money reaches the Indian exporter's bank account, and the banks will take the fees according to their charges. That is the concept of correspondent banking. I hope now that this thing is clear, that what is the meaning of correspondent banking. So basically, uh, what are the benefits of the correspondent banking? First thing is that there is global reach without physical presence. There is faster international transactions, lower operational cost for the banks, and convenient for the customer. So we can say that correspondent banks allow a bank to operate the internationally through the local partner banks who are acting as the agents. Is that clear? That what is the concept of correspondent banking? So, repatriable assets, money you can legally bring back to your home country, international banking, banking system that connects the countries financially, correspondent banking, bank helping each other across the border. Okay. Now we have what are the benefits of this correspondent banking? Advantages. First thing, this is the best idea because banks do international business without opening branches abroad. Obviously, it saves money, high operating cost, it saves, regulatory difficulties are not there. Then, second benefit is there is no need for global branch network. A medium-sized Indian bank cannot afford to open the branches in the USA, UK, Germany, UA, and anywhere. So it partners with the banks in those countries. It uses them as a correspondent banks. It still offer international services to the customers. Clear? Then second benefit overcomes licensing restrictions is I told you that every country is not allowing to open the branches in their country. So many countries they don't allow, they have strict banking regulation. So correspondent banking bypasses this problem legally. Example, China and some Middle East countries tightly control foreign bank entry. So Indian bank cannot easily open the branches there. So they appoint local bank as correspondent and continues their business without violating local laws. Then low operational cost, obviously, this saves building cost, stationery cost, and lots of things. Rent, they have to hire staff if they are going to open a branch. So all these things are saved in this correspondent banking. Instead of spending crores to run a branch in London, an Indian bank pays small based fees to UK for handling the payment. I think this is best than opening the branch. And obviously access to the global business opportunities. Without physical presence, banks can handle export and import, process the remittance, supports the NRI banking, and offer trade finance. So correspondent banks give small and medium banks global reach at the minimal cost. So, what are the functions, services provided by the correspondent banks? What are the functions, services are provided by the correspondent banks? Just a minute. Okay. So, here, first services there is the account services, which require accounting relationship. Accounting relationship. First one we have clear housing functions. What does it mean? The correspondent bank handles outward payment, whatever the money going out, and inward payment, whatever the money coming in. All through the all these things are maintained with the account, right? Suppose if Indian bank debits in nostro account with the US correspondent account, that means it maintains whatever the money comes in and whatever the money goes out. Then we have here collections. What is the meaning of collections? Correspondent bank collects exportable, importable checks on the behalf of the client bank. And after realization, it credits the amount to the client's bank account. Right? Then we have third payments. Payments we can do in the correspondent banking as a service because correspondent bank execute payment instructions of the client bank by just paying the beneficiary or by debiting the client bank account with it, right? Then we have here uh, overdraft and loan facilities also there. Here we can say that if the client bank account balance is temporarily low, the correspondent bank may allow overdraft, short-term credit, like overnight funding. It is also the services which is provided in the correspondent banking. And investment services also there. In the investment services, uh, if there is excess balance in the account beyond minimum required balance, the correspondent bank invests it in the overnight markets, earns the interest, pays the interest to the client bank, right? And then some other services we can include. In the other services, you can include uh, which basically may not require account relationship because these types of things are provided according to the credit worthiness, according to the reputation of the client bank. Example, LC. Now, what is the meaning of LC? We didn't do the LC. LC, letter of credit. This is the next chapter, letter of credit. This is a type of agreement between the exporters bank and importers bank. So importer and exporter can do their business without any problem. Why? Banks intervene, so the competitions is there, and exporter and importer keep increasing. They don't care about the payment and the shipping of goods. That's why bank intervene and uh, issues LC, letter of credit, as a trust agreement between the exporters and the importers. Right? So sometimes maybe it depends on the banks. They want to issue the LC, they want to confirm the LC or not. The correspondent bank also accept the draft on the behalf of the client bank. And correspondent bank also issues the guarantee, financial guarantees on the behalf of client bank. And also some foreign exchange services are also there. Fundraising services are also there. And training and seminars because correspondent bank provides training programs, updates on the global banking principles, practices, regulatory changes, and some the new products. Is it clear? So these are the services that are provided by the correspondent banking in the correspondent banking to the other bank. I hope the things are clear. If any problem is there, so please tell me, or if you getting the things, then you can also tell me that everything is okay. That will motivate me that I am going right. So, if I give you the small overview, what is the meaning of correspondent banking? Banks serve each other as agent across the countries. What are the benefit? Low cost, no branch needed, global reach, regulation easy. Account services are clearing, collection, payment, overdraft, investment. Other services, LC advising, LC confirmation, guarantees, Forex, fundraising, training. Right? Clear? Now, three main accounts we have. Nostro, Vostro, Loro. First, Nostro. Our account with you. Our account with you. When a foreign currency account maintained by our bank in another bank abroad. When a foreign currency account.
Okay. So, thank you. That is the concept of mirror account. Nostro Vostro I clear. No, mirror account I told you, that is a shadow of no Nostro account. It is used to record all the entries and it is used for reconciliation. So why it is needed? Just maintaining the Nostro account in the abroad, and entries maybe differ because obviously timings difference, bank charges, exchange rate delays are there. So bank need to maintain an internal record to just match the entries, identify the differences and correct errors. That is the mirror account, right? Okay. So you can take the exam, you can just learn with the help of example. There is a PNB Mumbai which is having an Nostro account in the city New York. Now PNB also keeps a mirror account in their own books which records every transaction whatever is going on in the Nostro account. So at the end this PNB compares city statement with the mirror account, finds the differences, reconcile them. So that's why mirror account is the shadow record of the Nostro account maintained for control and the reconciliation, right? Okay. Then we can learn here that some electronic modes of transmission payment system in which basically in international and domestic banking money do not physically move. Instead, secure electronic messages in settlement are used to transfer the funds, settlement the trade payments, pays the salaries, suppliers, universities, etc. So here these systems are broadly of two types. Some are messaging system which sends the instructions. Some are the payment and settlement system which actually moves the money. In which first of all we have learned one of the most popular important SWIFT, which is Society for Worldwide Interbank Financial Telecommunication, and the headquarter of this SWIFT is there in the Belgium. Headquarter is there in the Belgium. It is not a bank. It does not hold money. It is a communication system. Global secure messaging system. 11,000 plus banks are connected with this SWIFT. Most trusted by the banks, financial institutions and the corporates. They send the payment instructions, letter of credits, guarantees, trade messages, treasury messages. So it is the email system of banks and it is highly secure and standardized. So why the SWIFT is needed? Because without the SWIFT, bank obviously use telex, fax and phone and which is slow or risky. So there is very high chance of fraud and errors, right? But with Swift you can say messages are standardized, secure, fast, and also globally accepted. So it is, we can say 11,000 plus banks are used in 200 plus countries, and it is available 24 hours, 7 days, 365 days. It is available every day. It is very highly cost effective for the banks. And here, earlier bank used bilateral key exchange, but now it is not used. So you can say that Swift is one of the most important communication system. Is that clear? Now we have here new. Old system is this. Old system is the BKE, which is bilateral key exchange. In this, what happened? Generally, two banks exchange their secret keys. Messages are authenticated by just using these keys. Now the new system is the RMA, Relationship Management Application, where bank authorize each other in the Swift system. Only approved banks can exchange the messages. It improves control and the security. Right? Next, not that much important, but you can just read them. That CHIPS is from the New York, USA. Settlement is net, US based system used for large value US payment system, especially for foreign exchange and euro dollar settlement. Right? Then we have CHAP. Here, CHAPS is clearinghouse automated payment system, and Target is euro based payment system. The work is same. RTGS plus an EVA is euro based system, but from India we have RTGS. RTGS managed by RBI through the IDRBT. What is this IDRBT? IDRBT, we have Institute for Development and Research in Banking and Technology. That is the IDRBT, Institute for Development and Research in Banking Technology. Right? It is basically for driving the technologies innovations in the India's and financial sector. So RTGS is where money is transferred in real time on gross basis between the banks in the India. Right? Most popular one, but here is the minimum transaction of 2 lakhs. Who manages RTGS? Technical support by IDBRT Hyderabad. How this RTGS work? Because all the banks are connected to the RBI central server. Each bank maintains a pool account with the RBI. When transfer happen? When sender pool account is debited and receiver bank pool account is credited. What is the limit? 2 lakh is the minimum limit and maximum limit is no limit. So minimum you have to do the transaction of 2 lakh with the RTGS. So basically then we have NEFT. You can ignore this one. Batch based system. National Electronics Fund Transfer, which is used for small and medium value transfer. It works on batch settlement. 24 into 7 into 365 days it is available. Maximum no limit, minimum no limit. Every 30 minutes it works on the batch basis. Total 48 batches per day. First batch starts on 00.30. Last batch is 2330. Right? So that is the thing here. and it is adjusted through the RBI pool account, not real time but very frequent, very fast. It receiving bank must credit within 2 hours of settlement batch. So if a person sends 5,000 to a friend, he have to use NEFT and amount is credited in the next batch. So now this is a quick comparison, you can read it, and this is complete all the systems which you can read. It is basically for that, so it will help you to do the quick revision. Now the most important thing, NRI. Who are the NRI? If we listen this word NRI, in our mind the one thing is come that who lives outside the India are called NRIs. But NRI having two definition. One is according to the Income Tax Act, one is according to the FEMA Act. First we have Income Tax Act. A person who stays in India more than 182 days in the previous financial year is called resident. Less than 182 days is called non-resident. Right? If a Raj stays in India for 150 days in financial year and rest abroad, he is NRI. As per the FEMA, if a person who is residing outside India and don't know when he will or she will come back to the India, and he is outside the India, person is outside the India for the education, for work, for anything, employment, and don't know when he will come back to the India, that person is considered NRI, which include employment abroad, business abroad, international organization. He is working in the international organization like UN, United Nations, World Bank, IMF, etc. So who are the PIOs? Person of Indian origin is a foreign citizen who is not belong to Bangladesh and Pakistan, who has Indian roots. He was once the citizen of India, is the child, grandchild, great-grandchild of an Indian citizen, or he is the spouse of an Indian citizen, he having an Indian passport, his grandparents or parents were Indian citizen. So American citizen whose grandfather was Indian, it is called person of Indian origin. Who can or other person are treated as NRI? Indian government officials who are abroad, who are working abroad, students going abroad for higher studies, foreign spouse of Indian citizen, and tourist on short visit who are not NRIs. Right? So why the NRI is there? Like, what is the NRI banking? Why we need this NRI banking? Okay, I told you this thing in starting that India has million of citizens who are working abroad, who are running their business abroad, who are studying abroad, who are permanently settled abroad, but they still needs the bank accounts in the India. Right? They are interested in the investment facilities. Right? They do the repatriation of the funds. Right? They do property purchase as well as maintenance. Right? And also family support is there. They provide family support. So RBI and Government of India has framed special rules under FEMA for the NRIs. Right? Now you can just check that what are NRE account, NRO account, FCNRB. NRO must be in the rupee, NRE also in the rupee, but FCNRB account is in the foreign currency. Account type is saving account, current account, RD, recurring deposit, fixed deposit. But NRE is also in the same. FCNRB is only the fixed deposit or term deposit. Joint account allowed in every case. Nomination is allowed. Person can nominate, NRI can nominate. Interest is taxable in the case of NRO, not taxable in NRI, and not taxable in FCNRB. Repatriation, yes, up to $1 million per year is repatriable. In NRE case, full amount is repatriable. In the FCNRB case, full amount is repatriable. Right. Now, source of funds, obviously foreign sources can be included. Indian income, only the foreign remittance in the case of NRE, and in the FCNRB only the foreign remittance. Right. Then we have here exchange risk is nil in the NRO. NRE, it depends on the customer. In the case of FCNRB, it depends on the bank. In the interest rate as per the banks in the case of NRO, as per the banks in the case of NRE, and it is linked to the LIBOR. Minimum fixed FD is for 7 days, for 1 year, and maximum is for 10 year and 5 years. Now, one term, here is the one term which is OCB, overseas corporate bodies. What is it? Overseas firms, trust companies owned at least 60% by the NRIs. 60% at least by the NRIs. OCBs are not allowed to make investment in the India. This is important thing. OCBs are not allowed to make investment in the India. Right? Okay. So what is NRE account? A rupee account where we can park foreign earnings in India with full repatriation. Currency is rupee. Interest is tax free. Exchange rate, it depends on the customer, and types are saving account, current account, recurring deposit, fixed deposit, repatriation, fully available. Remittances from abroad is allowed. Transfer to the NRE account allowed. Foreign currency notes, traveler check during visit to India are allowed. So NRE to NRE account allowed, NRE to NRO allowed, NRE to NRE not allowed, NRO to NRE account not allowed. So if a NRI in the UK gifts British pound 5,000 to the India, it can be credited to the NRE account. It can be converted to the INR account. Interest earned is tax free, and it can be sent back abroad anytime. Same, what is the meaning of FCNRB account? A fixed deposit account maintained in the foreign currency. A fixed deposit account maintained in the foreign currency. Right? So what are the features? You can see here, I already told you what is the meaning of power of attorney, where the joint accounts are allowed of the NRE and NRE. Two NRIs can open an account. NRI and PIO can open the account. NRI plus resident relatives, they can also open the account. Former and survivor basis. First, what is the meaning of this? Former or survivor basis. If any account is open, all the things are in the hand of former, but when this former dies, all the responsibility automatically shifts on the survivor, like that means second holder, right? And power of attorney holder, they can't withdraw the cash locally. They can remit the funds only to an NRI account holder. They cannot gift or transfer funds to the third parties. Clear? That is the POA holder restrictions, or the resident relatives restrictions, or the facilities which are available to them. Is that clear? Okay. Now, apart from this, we have NRO account. Let me give you the overview of the NRO account. What is the full form of NRO account? Non-resident ordinary rupee account. It is basically an normal Indian rupee account. Indian rupee account for the NRIs who can manage the income earned in the India. Right. So, currency is rupee here. And what is the type? Saving account, current account, recurring deposit, fixed deposit. Right. Income is taxable around 30% plus surcharge. Right. Also, repatriation is limited here, only up to $1 million per year. And transfer is allowed to NRO to NRO. NRO to NRE is still not allowed. Who can open? NRI can open, foreign tourist can open. And when a resident become NRI, his existing resident account redesignated to the NRO account. Clear? Okay. Then we have here, okay, we have here one more SNRR account. What is SNRR account? SNRR account is special non-resident rupee account, meaning this is a rupee account for the foreigners, right? NRIs who are having interest, business interest in the India, right? Who are having the business interest in the India. It is used for not violating FEMA rules. Currency is rupee. Tenure at least maximum 7 years. Taxable. And basically if NRI become resident, so it will be converted to the resident account. And Pakistanis and Bangladeshis, they need RBI approval to open the SNRR. So that is the thing. That is the thing about the different types of account. So we can see, we can say here in quick way that NRO interest is taxable, NRE interest is tax free, FCNRB account has no exchange risk for customer, SNRR tenure is maximum 7 years, and minimum NRI ownership in the OCB is 60%. Okay, so what is the meaning of irrevocable letter of credit? Irrevocable letter of credit that can be cancelled, that can be changed without the consent of all the parties. That in the revocable, it can be changed, right? And consent is not required. But in irrevocable letter of credit, it cannot be cancelled. It cannot be altered without the consent of all the parties. That's why one of the securable, trustable type of letter of credit. And it also gives security to the exporter. Once the LC is issued, buyer cannot cancel it without the seller's approval, right? That is the irrevocable letter of credit. Clear? Now we have here third, irrevocable confirmed letter of credit. In addition to the issuing bank, another bank is there who guarantees the payment to double confirmation, double security, and it is very safe for the exporter. Indian bank issues the LC, UK bank confirms it. Even if Indian bank fails, UK bank will pay. That is irrevocable confirmed letter of credit. Then we have transferable letter of credit. Beneficiary can transfer to another party. Beneficiary can transfer the LC to the another party, but this second beneficiary can't transfer to the third party. It is used when middleman is involved. Trader receives LC from buyer and transfer part of it to the actual manufacturer. That is transferable letter of credit. Clear? Right. Now, red clause letter of credit, which allows exporter to receive the advance money. What happens in this case? If suppose importer places a order for manufacturing a jet plane, right? For a jet plane. Now exporter accepts the order but demands some advance payment. When this exporter needs this advance payment to start the manufacturing process, that case is called red clause letter of credit. It is used to buy the raw material or prepare the goods. Exporter receives 20% of advance to purchase fabric before stitching the garments. That is the concept of red clause of LC, and it is also rarely used in today's era, and it is also print in red letters. Right. Then we have green clause letter of credit. Green clause letter of credit means where it is similar to the red clause LC. Here advance is also given, but for warehousing the goods, because goods are stored in the warehouse, and it requires exporter have to show that the evidence that goods are warehoused. So advance is given by the importer to the exporter in the green clause of LC. Exporter stores rice in warehouse and shows the receipt. So bank give advance against it. That is the concept of green clause letter of credit. Clear? Now kindly confirm that my voice is okay now. Is any problem? So please tell me. Now you can see here, revocable, that can be cancelled anytime. Irrevocable can't be cancelled without consent. Confirmed, two banks guarantee the payment. Transferable can be transferred to another party. Red clause, advance payment allowed. Green clause, advance after the warehousing. Clear? Now, if in single words I am going to say that what is LC? Bank promise to pay. Importer is the buyer, exporter is the seller. Issuing bank is the buyer's bank, advising bank is the seller's bank. Confirmed LC is extra guarantee. Red clause, advance before shipment, and green clause, advance after the warehousing. Got it? Now, what is the meaning of sight letter of credit? Sight letter of credit. In this case, after getting the documents, after checking that all the documents are good by the exporter, they provide the documents and everything is fine, that payment is done on immediate basis. There is no waiting period. That is called sight letter of credit. What is acceptance usance letter of credit? When documents are presented, documents are checked, but here the due date is given that the payment will be happen on this due date. There is the waiting period. Example, 30 days, 60 days, 90 days, right? So bank accept the bill and pays on the due date. LC says payment after 60 days from the shipment. So exporter gets money after the 60 days. That is the concept of the usance LC. In the case of sight LC, payment is done on immediate basis, but in the case of sight LC, payment is done on the In the case of site LC, payment immediately, but usage after a waiting period, payment is done to the exporter. Clear? Now, this is the concept of all the types of LC. One more type LC is there, which is called deferred payment letter of credit. What is it? Questions can be there from this type of, in which basically payment is made on a future specified date. Payment is made on the future specified date, and here bill of exchange is not required. Bill of exchange is not required. Data and all the date is clearly mentioned in the LC. Right? Example, if LC states that payment on 30th of June, so exporter gets money on 30th of June if he submitted all the documents and if there is no problems in the document. Right? Now, negotiation letter of credit. One more term we have, negotiation letter of credit. What is it? Negotiation letter of credit. Here, issuing bank authorizes another bank to negotiate documents and pay the exporter. Right? Here, issuing bank authorizes another bank to negotiate documents and pay the exporter. The bank later claims money from the issuing bank. So exporter submits document to his bank, bank pays exporter, bank collect money from the issuing bank after some days. That is the concept of negotiation LC. Clear? Is that clear? That what is the concept of negotiation LC? Okay. Now we have, what is this UCP 600? UCP 600 is the 6th revision. Before this UCP 600, we have UCP 500. It applied in 2007, which says Article 1 to 5 are dedicated to the definition and what are the meanings of term. LC is independent of the sales contract. Bank only deal with document. Banks are not responsible for the goods quality, goods like goods are not up to mark, goods are missing. Banks are not liable for this. Banks are liable only for the documents. So Article 6 to 10, LC is available. What is the expiry date? What is the place? What are the duties of the issuing and the confirming bank, and what are the amendments? Then we have Article 11 to 17. Pre-advised credits are there. Nominated banks, reimbursement, complying the documents and the original documents should be there. Article 18 is about the commercial invoice. Invoice must be there. And 19 to 27 deal with the transport document, which include bill of lading, airway bill, everything. Right? That is included in the Article 19 to 27. Article 28 dealing with the insurance documents. Article 29 to 33, if any LC require extension, what is the quantity and the amount is allowed. Partial shipment. Partial shipment means if the order comes from the truck, then shifted to the water transport, then shifted to the air transport, that is called partial shipment. Half of the order is done, is shipped, and rest of the order is left and it is shipped again by other way, or everything will be in the banking hours. Article 34 to 37 is called disclaimers, that banks are not responsible for goods and any delay. They are only responsible for the documents. Article 38 to 39, transferable NC and assignment of the proceeds. Right? So, in the documents, what are the documents that are required under the LC? First, we have the most important bill of exchange. It is given by the exporter to the bank, pay the money. It can be immediate basis like sight, or it can be usance like some waiting period should be there. So exporter draws bill on issuing bank for US dollar 50,000. What is the meaning of invoice? It is prepared by exporter. Have you ever seen invoice? It is similar to the bill. When you purchase the things from the showrooms or shops, they give you the bill. That is similar to the invoice. It is prepared by the exporter. It shows what are the goods, how many quantities are there, what is the total value. So 1,000 shirts at $10 each, that means dollar 10,000. These types of details are written in the invoice, right? And what here we can say that UCP 600, UCP 600, what is the complete name of UCP 600? Uniform Customs and Practices, Uniform Customs and Practices for Documentary Credit, right? This is UCP 600 and it is effective from 1st of July 2007. It is issued by the ICC, International Chamber of Commerce. It is issued by the ICC, International Chamber of Commerce, and it contains 39 articles. Earlier 49 articles, but now it has 39 articles. In this, rules are standard and some disputes are there, right? Now third, we have bill of lading. Bill of exchange is done, invoice is done. The most third one document which is required, bill of lading. What is this bill of lading? It is the proof of the shipment of goods. That goods are shipped, that is the proof. It is issued by the shipping company. Shipping company issues this bill of lading, and also it shows port of loading and destination. It tells about the loading port and destination. So goods shipped from Mumbai to Dubai, that is included in this bill of lading. Got it? Then we have insurance policy. Insurance policy, or you can say that certificate, right? So proof that the goods are insured. This is the proof the goods are insured, and that should be match the LC description. Also, it is issued by the insurance company, not by the broker, right? Not by the broker. Also, insurance for goods worth 1 lakh against the sea risk is the insurance policy certificate. Got it? Now we have here insurance certificate policy is done. Then we can say what is the certificate of origin. Certificate of origin, what is it? See, it shows where the goods are made, where the goods are generated, manufactured, which country issued, and it is issued by the ICC or authority. So then we have packing list. Packing list or wait list, right? Means in this all the details of packing, cartoons, weight is mentioned, and it must match the invoice as well as bill of lading. Clear? And now what is crystallization of foreign currency liability? When the foreign currency amount are converted into the Indian rupees, it is done due date on the due date in the usance bill, as well as, just a minute, here it can be earlier if importer request in writing. What is the evidence of import? Importer must submit bill of entry copy, bill of entry details summary to prove that goods have actually been imported. What are the risks in the letter of credit transaction? Documents may be contains mistake, local law conflict with the UCP rules, maybe there are currency restrictions, or importer refuses documents until goods arrive, quality disputes after the delivery. So importer if says goods are damaged, refuse to pay, even documents are accepted, that are the risks which are available for the exporter. Standby letter of credit, it is like a guarantee. When buyer fails, here this standby letter of credit pays. Contractor fails to complete work, beneficiary claims the money under the SBLC. Right? That is the concept of standby letter of credit. Clear? Now, let's learn about what is the use of this standby LC by the authorized dealers. Because banks in the India, they can issue standby letter of credit for export into the India, for the foreign exporter that's selling goods to the India, for the foreign exporter who are selling goods to the India, and amount owned by the foreign resident to the Indian resident, means must be genuine trade transaction should be there, and counter guarantee backed up by the counter guarantee for reputed foreign bank. If UK buyer owes money to Indian exporter, UK bank gives counter guarantee and Indian bank issues the SBLC. And export from India, Indian exporter may choose to receive standby LC instead of normal LC. Right? Then we have most important URR, Uniform Rules for Bank to Bank Reimbursement, URR 725. What is the meaning of this URR 725? So let me give you the overview about the URR 725, Uniform Rules to Bank Reimbursement. It is established by ICC. These rules governs how bank reimburse each other for payment that are made under the LC. Right? That are made under the LC. These rules are under the ICC, which aim to reduce the problems in the process of LC, and it applies when it is written in the LC that it is subjected to URR 725. It covers all the definitions, liabilities, procedures, amendments and cancellations also. Right? Now, these rules govern reimbursement between banks under the LC. Issuing bank issues the LC and gives reimbursement instructions. Reimbursing banks, that pays the claiming bank as per the authorization. And what is claiming bank? That pays the exporter, accepts the bill, negotiates the document, then claims the money from the reimbursing bank. So what are the liabilities and responsibility? Issuing bank have to provide all the information. Issuing bank cannot ask for certificate of compliance. Reimbursement authority may not have expiry, must not have any expiry date. Reimbursing bank pays only under taking exist, and all these things done through the authenticated system, that is SWIFT. It mentions all the details: credit number, amount, currency, claiming bank name, responsibility charges, and also attach the copy of the LC. Right? That is the concept of the standby letter of credit. Clear? So, before moving this, let me confirm one more thing. We have ISP 98. What is 98? This is basically International Standby Practices. What is it? In this, we have some important articles which are rules for the standby LCs. Right? Article 1.02, which is tells about laws and IFSP 98. Article 1.09, it is for bank and business day, that what is the business day and what is the banking day. Article 3.13, it is for expiry of the non-business day. Article 5.01, which tells about timely notice of the dishonor, that if bank reject the claim, so must inform that thing in a very quick manner. And then we have here ISBP 745. What is it? It is International Standard Banking Practice. Right? What is it? ISBP gives guidance on how banks should check the documents. Uniform practice should be there worldwide. It reduced the document rejections. It held customers in avoiding any type of mistakes. And it invoice gives the format guidance, and if any problem is there with the LC, so it directs the exporter that you have to provide this type of work. Right? Incoterms 2020, International Commercial Terms. What is the meaning of this Incoterms 2020? Incoterms 2020. These are the globally recognized rules by International Chamber of Commerce that defines sellers and buyers' responsibility for the cost, for the risk, for the delivery in the international trade, and it is effective from 1st of January 2020, and it completely clarifies who handles the task like transport, insurance, customs, and here are the 11 rules which are split for any mode of transport. Right? Now, one more thing I have to tell here. In this Incoterms, basically, you can say that Incoterms are the globally recognized. In this chapter, basically this chapter is completely conceptual chapter. Right? Question they can ask from the rules in the form of case study, or directly questions they can ask. They can make the case study on the USINS bill, on the site LC, or the expiry and the business days, articles. So most important thing to deal with this chapter, to read all the concepts carefully, and if you need any type of help regarding any type of topic, you can comment down. I will be helping you. Right? I hope the things are clear, that what is documentary letter of credit, what are the parties, what is UCP 600, what is URR 725, what is standby letter of credit. So these are the important topics in this, and one of the most important is also this Incoterm. It is issued by the ICC, it explains the responsibility of the buyer and seller, that the buyer is responsible for what things and seller is responsible for what thing. It is applied to sale contract, not for the transport contract. 11 Incoterms are there, and if I give you a name of these 11 terms, 11 Incoterms, in which we have EXW, FCA, FOB, FCA, FOB, CPT, then CIP, DAP. I will explain every term. Then DPU, DDP, right? And some are the sea inland waterways, in which we can include FAS, FOB also included in this, and CFR or CIF. First, let's learn about the departure terms. EXW, X works, where seller make goods available at his place. Seller makes goods available at his place, buyer bear all the cost and risk. Example, EXW Pune, buyer arranges pickup, transport, export, import, everything. Then main carriage paid, in which we include seller pays main transport cost. CFR, cost and freight, seller pays freight, buyer pays the insurance. CFR Chennai, seller pays ship cost till Chennai. CIF, cost, insurance and freight, seller pays freight and insurance. CPT, carriage paid to any mode of transport. CPT Dubai, seller pays here transport till the Dubai. I will share the chart with you also, that will help you out in understanding this Incoterms in easy manner, and these Incoterms are very important, right? Now CIP, carriage insurance paid to, where seller pays transport plus insurance. Now main carriage unpaid, buyer arranges main transport. FCA, seller hands goods to the courier. FAS, free alongside ship, seller pays goods beside the ship. Free on board, seller loads goods on the ship. And arrival terms, seller bears all the risk till the destination. Then we have DAT or DPU, because DPU replaces this DAT, where means seller delivers goods unloaded at the destination. Delivered at place, that means seller delivered the goods, buyer unloads, right? And then we have delivery duty paid, DDP, means seller pays all the cost plus the custom duty, right? So now we can say that SBLC is the guarantee instrument, ISP 98 is the rules for the standby LC, URR 725 is what? Bank to bank reimbursement rule, ISBP 745 is how to check the documents, Incoterms 2020 is buyer seller responsibility rules, FOB is seller loads on ship, CIF is seller pays cost, insurance and freight, DDP is seller pays everything. So based on this, tell me the answer of this first question. Do the comment that which option is correct according to you. What is the meaning of dog decks? An option available to the parties of LC, which is used for in resolving the LC disputes. So kindly try to give the answer that what is the meaning of this dog decks. Which answer is correct according to you? It is a specialized bank, it is a document verification service, it is a type of LC, or it is a ICC's documentary credit dispute resolution expertise. Which option is correct here? So let me tell you about DocDex. What is the meaning of DOCDEX? It is a dispute resolution mechanism. Dispute resolution mechanism which developed by the ICC. It is specifically used for resolving the disputes which arises under letter of credit, collections and guarantees. DocDex provide expert decision based on the ICC rules such as UCP, ISBP. It is not a court or not a bank. It helps the parties in resolving the disputes quickly, confidently and cost effectively. And the decision of binding only if parties agree to bound by it. So the correct answer is here option D. It is a ICC documentary credit dispute resolution expertise. Next question. Who is authorized to issue and sign a certificate of origin in trade transaction, especially for determining the origin of goods? Which answer is correct according to you in the given question, that who is authorized to issue? What is certificate of origin? Certificate of origin that tells that certifies basically the country in which goods are manufactured, in which country goods are manufactured or produced. It is generally issued and signed by independent authorized body, which mostly commonly the Chamber of Commerce or a similar recognized authority. And it is not issued by the LC beneficiary or applicant. Custom authorities verify the certificate but usually do not issue it. This is a standard concept which is tested in international trade finance. So the correct answer is it is an independent authority like the Chamber of Commerce. Next question. What is the standard coverage amount for an insurance policy on certificate in the absence of specific LC instruction? Standard coverage amount. Which is the correct option here? So let me tell you the answer. As per the UCP 600 rules and Article 28, when a letter of credit does not specify the insurance coverage amount, the insurance policy or certificate, they have to cover at least 110% of the CIF or CIP value of the goods. Why 110%? Because it covers the value of the goods, right? And also it anticipated profit and incidental expenses are 10%. Value of the goods are 100% and extra 10% is also there. And banks will treat insurance for less than 110% as a disparity unless the LC clearly states otherwise. So which option is correct? Option C is correct. 110% of the CIF and CIP value of goods. In the transshipment scenario, what happens to the goods after they loaded onto one ship? In the transshipment process, what happens with the goods? So read the option and tell me the answer. Very simple answer. What happens in the transshipment method? First, goods are loaded onto one ship and then unloaded at an intermediate port or transferred to another ship or another mode of transport. Transshipment involves change of vessel or transport mode. It is not direct shipment to the consignee. So the correct answer is they are transferred to another mode of transportation. Option B is correct. Within what lifetime should the bill of lading be submitted to the negotiating bank under an LC? Within what time frame? Simple answer is there. As per the UCP rules, Article 14, subsection C, here, if a letter of credit does not specify a time limit for a presentation of document, so the bill of lading and other document must be presented within 21 days from the date of shipment. This 21-day rule applies only when the LC is silent on the presentation period. Presentation must also be within the validity of the LC. Bank treat presentation beyond 21 days as a disparity. So the correct answer is here option C. Option C is the correct answer. Now, here some questions are there which I am, three questions are there which I am giving you in the homework. Kindly read the chapter and comment your answer for question 1, question 2 and for question 3. Right? So,
A chapter that is facilities for exporters and importers. In this chapter, we are going to learn that what are the other types of facilities which are available only for the exporters and importer so they can do their business without any problem. What type of finances and everything. We will do some questions today on this chapter, and with the help of the questions, we will brush up our concepts. So I hope that I am audible, my screen is visible, everything is okay. So let's start with the class. And here you have to give answer of every question. That also helps you to check your knowledge regarding the chapter. So let's start with the class. And here is the first question. Under which regulatory authority are the financing of export and import trade as well as facilities granted under the FEMA regulations governed? So read the question carefully and try to give the answer. Which regulatory authority are the financing of export and import trade as well as facilities which are granted under FEMA regulations governed? Which of the option is correct here? Is it Ministry of Commerce and Industry? Is it RBI? Is it Ministry of Finance or Ministry of External Affairs? See, when the talk is about financing of export and import trade and all the facilities which are granted under the FEMA regulation, the one and only answer is the Reserve Bank of India. See, you know that reading is not appropriate, reading is not enough to clear your examination. You have to do practice as much as you can because that boosts your confidence and also that helps you to understand that what are your weak areas and what are your strength areas. So let's
uh, practice some questions which are related to the facilities for imports and exporters. So first question, I told you that Reserve Bank of India is the regulatory authority which finances the export and import trade and also facilities granted under the FEMA regulation. This is basically the regulatory authority which is completely responsible for what? For financing of export and import trade, right? You can take example like pre and post shipment finance or export credit. If some exporter is any exporter wants some credit regarding to their uh, export, so they can take from the RBI, right? And also pre-shipment and post-shipment credit facility is also available. Apart from this, here administrate administration and regulation under the FEMA, because it includes facilities which are related to the foreign exchange transaction. And there are other ministries that plays policy or diplomatic roles, but they do not directly regulate foreign exchange uh, or trade financing. So which option is correct here? Here our option B is correct, that is Reserve Bank of India. And also you can tell me, let me know in the comments that you want theory or you want only the questions. So next question, in which situation may an authorized dealer accept export documents which is submitted by the exporter after the specified period of 21 days? Who are the authorized dealers? Who have the license to deal in the foreign exchange transaction, and this license is they got from the RBI. So in which situation an authorized dealer accept the export documents which are submitted by the exporter after the specified period of 21 days? So try to give the answer of this question. If we talk about RBI and FEDAI guidelines, what the guidelines are saying, that an authorized dealer, they may accept the export documents beyond the prescribed limit of 21-day period when when only the delay is due to the genuine reason, which is when the delay is due to the genuine reasons which are beyond the control of exporter, right? In that case, authorized dealer can accept the documents after the specified period of 21 days. So the correct answer is option D here. Option D is correct. A, B, C options here do not constitute some valid regulatory grounds for the delay. So here option D is correct. Got it? Now, next question. Who is responsible for regulating the export and trade control guidelines for exporters in the India? Who is responsible for regulating the exchange and trade control guidelines for the exporters in the India? And I hope that you know the answer of this. So kindly give the answer that who is responsible. So the four options are given, and which option is correct? Ministry of Commerce and Industry, RBI, Ministry of Finance, या DGFT. Try to give the answer. It will help you to test your knowledge. So the correct answer is the DGFT. This DGFT, Directorate General of Foreign Trade, that works under the Ministry of Commerce. Ministry of Commerce and Industry. This is responsible for formulating and administrating the foreign trade policy, right? They also issue export import like exim guidelines, procedures, and also other trade measures, other trade guidelines, other control guidelines, which are completely applicable for the exporters and the importers. Now the thing is there that DGFT is doing that work. Who is regulating the exchange and control guidelines? Do you know what is the meaning of this FTP, foreign trade policy? FTP, foreign trade policy. Do you know any overview about this foreign trade policy? See, FTP, we can say that this is a government framework that sets the rules for the nations uh, international trade, and it also focus how to regulate the import, how to boost exports through incentives, initiatives, and streamlined process. So the correct answer of this question is D, DGFT. Option D is correct. DGFT is the correct answer. Yes, correct, Vishwant sir. D option is correct. Next question. Under what circumstances can the realization period be relaxed, allowing a longer time frame for repatriation of export proceeds? Under what circumstances can the realization period be relaxed, allowing a longer time frame for repatriation of export proceeds? Which option is correct here? See, simple answer. Under the RBI FEMA guide regulations, there are standard realization period for the export proceeds. Currently is having 9 months, or they may be relaxed in some specific cases. What specific cases? When goods are export to the warehouses, these warehouses established outside the India, right? These warehouses established outside the India for stocking and subsequent sale. In such cases, RBI permits the realization period because the sale may occur at the later date. Obviously, sale may be occur at the later date. That's why RBI permits an extended realization period. So here other options are not valid because international delay is not permitted, and uh, exporters financial difficulty is not a regulatory basis for extension, and there is no relaxation based on export value threshold. So which option is correct? Option B is correct here, when the goods are exported to a warehouse outside the India. Next question, which documents need to be submitted within the prescribed 21-day limit for the exports? Which are the documents or the forms are here? Read the option and try to give the answer. Both EDF and Softex. Both forms, EDF and Softex. As per the RBI guidelines or as per the FEMA guidelines, FEMA regulations, EDF means export declaration forms, and this form is required only for the physical goods. Then we have Softex form. Softex means this is applicable for export of software and IT enabled services. For the IT enabled services and for the Softex form. Now, what is this Softex form? Basically, this is for the softwares, right? And if we say that software technology parks of India, that is having a different we can say work. Softex full form we can say software export declaration form, right? So Softex, and this is applicable for the export of software and IT enabled services. Both forms are required, submitted to the authorized dealer, right? Both forms need to submit it to the authorized dealer within the prescribed limit of 21 days. And IEC forms are for the registration purposes. IEC forms are for the registration purposes, and they are not the part of 21-day export submission requirement. So the correct answer of this question is option C, both EDF and Softex form. Is that clear? Now, next question. In accordance to the FEMA regulation, how must the full export value of goods be received by an authorized dealer? In accordance with the FEMA, how must a full export value of goods be received by an authorized dealer? So simple answer, under the RBI and the FEMA guidelines. Here, the full export value, of goods must be realized and received through an authorized dealer bank in the manner prescribed by the bank and in accordance with the permitted modes of payment. Now other options here, other options. Option A, cash receipt is completely not permitted for export proceeds. Exporter cannot choose any arbitrary method. It must be comply with the RBI and authorized dealer bank rules. Then personal check from buyers are not accepted or secure mode under the FEMA. So the correct answer is in a manner specified by the authorized dealer. That is the correct answer here. Got it? I hope the things are clear. With the questions, our most of the things are clearing, like most of the concepts are cleared. Still having any problem, you can tell me. And one more thing I want to tell you here, what is the meaning of export proceeds? Basically, these are the earnings or foreign currency an exporter receives when he's selling goods or services to the buyers in the other countries, especially in the international sales. That is called the export proceeds. Got it? Next question. Under what circumstances can the RBI or authorized dealer extend the stipulated period for realizing and repatriating the export value? What circumstances are there? Again, according to the FEMA and the RBI, according to the FEMA and the RBI, basically RBI or authorized dealers, RBI or authorized dealer, they can extend the stipulated period for realization and repatriation of the export proceeds when only when the exporter is able to demonstrate sufficient and reasonable cause for the delay. When exporter is able to demonstrate sufficient and reasonable cause for the delay, maybe the reason is buyer's insolvency, maybe the reason is dispute, political risk. So other options are incorrect here. Payment of a fine is not a precondition for extension. A legal document alone does not automatically justify the extension. Extensions are not automatic and must be requested with justification. So the correct answer is option B for sufficient and reasonable cause shown. Which of the following is a valid form of receipt for foreign exchange by an authorized dealer? Valid form of receipt. Obviously, foreign currency notes and the traveler's check, because according to the FEMA and RBI, export proceeds must be realized through approved banking channels like foreign currency notes and traveler's check, and these are recognized as the receipt. These are recognized as the receipt by authorized dealer, but some regulatory conditions are applied. If we talk about the bitcoins, they are not recognized as a legal tender or permitted mode under the FEMA. And jewelry, this is not a wallet, and artwork, not a permitted mode of settlement. So the correct answer is option C, foreign currency notes and the traveler's check. Got it? So under what conditions can agency commission on exports be allowed either by remittance or deductions from the invoice value by the authorized dealers? Under what conditions can agency commission on export be allowed either by remittance or deduction from the invoice value by the authorized dealers? Again, according to the RBI and FEMA guidelines, agency commission on exports may be allowed by the authorized dealers, right? Agency commission on exports, these are allowed by the authorized dealers either by the direct remittance or deductions from the invoice value. And this is possible when the commission is properly declared in the EDF soft tax form and accepted by the custom authorities. So this obviously ensures some types of transparency and regulatory compliance. Basically, other options are incorrect here because authorized dealers request alone is not a regulatory basis. Shipment scheduling has no relevance to commission approval, and cash payment of commission is not permitted. So the correct answer is option B, when the exporter declares it in the EDF soft tax form and it is accepted by custom authorities. So option B is correct here. Next question. How the discount rate for prepayment of usance bills typically stipulated in export transactions? How the discount rate for prepayment of usance bill typically stipulated in export transactions? See, generally in the export bills, when the usance bill are prepaid or discounted, so the discount rate is typically stipulated at a fixed percentage of invoice value in the contract or commercial terms. In the contract or the commercial terms, because this rate reflect interest for the usance period or bank charges and discounting cost. And the other options are incorrect because seller preference alone does not determine the rate, buyer request is not governing factor, and DGFT does not fix the discount rates. So the only correct answer is option B, at a fixed percentage of the invoice value. Next question. What condition must be met for banks to allow the claim against export bills? What are the conditions that must be met for banks to allow claims against export bills? So which option is correct? Here, according to the RBI and FEMA guidelines, basically we can say banks are permitted to entertain the claims. Banks are permitted to entertain the claims such as deductions, short payments against the export bill only after the export proceeds have realized and repatriated to the India. Right? This ensures that foreign exchange inflow is secured before any claims are settled. So, which of the option is correct? Option B is correct. The export proceeds have been realized and repatriated to the India. Option B is correct here. Next question. What additional condition must be met for the approval for reduction in invoice value by the authorized dealer? What additional condition must be met for the approval for of a reduction in invoice value by the authorized dealer? Which of the condition is correct? See, most important thing is that according to the RBI and FEMA, authorized dealers, they can approve a reduction in the invoice value, right? They can approve, but according to the some condition. In addition to the limit on the percentage of reduction, that exporter must not be in the RBI caution list. Must not be in the RBI caution list. Exporters who are there on the caution list, they are subject to enhanced security and as well as restrictions. So basically, other options are incorrect because option A is saying seller discretion alone, it is not valid regulatory basis. And in the B option, standard regulatory cap is not 5%, it is 10%. And reductions are case specific, which are not mandatory for all exports. So the correct answer is option C. The exporter should not be on the exporters caution list of the RBI. Option C is correct. Now, when should an exporter apply for an extension of time limit for realizing the export proceeds? When should an exporter apply for an extension of the time limit for realizing export proceeds? See, what guidelines say? Exporters should apply for the extension of the realization period when they are unable to realize the export proceeds within the given time, right? Uh, and for those reasons which are genuinely beyond their control, like buyer default, disputes, political risk, insolvency. So here we can say that which option is correct? Option C is correct. If the exporter is unable to realize export proceeds within the prescribed period due to reasons beyond their control. Next question. What condition must be met to grant an extension of the time limit for realizing export proceeds beyond 1 year from the date of export? Beyond 1 year from the date of export. So in that case, which condition is required? See, that is also allowed by the authorized dealers. But the condition is that exporters total outstanding total outstanding that should not exceed US dollar 1 million or 10% of the average export realization, and in which they take the time of 3 previous financial years. So whichever is higher, they will take it as a reason. And this condition ensures that extensions are granted only to exporters who have a good record, and also they are able to manage the outstanding exposure. So the correct answer is option D. What is the effective date of realization of an export bill which is denominated in rupees according to the FEDI rules? FEDI, which is in self-regulatory organization, their rules for exports bill are denominated in Indian rupees. The effective date of realization is considered to be the date on which foreign bostro account is debited. So obviously overseas buyer actually leaves the foreign bank and it is reflected on authorized dealer's bank account. So the correct answer is the date on which the bank vostro account is debited. Now, just a minute. Yeah, which what is the key difference between factoring and forfeiting? I think the most important concept in this chapter, factoring and forfeiting. So what is the difference between factoring and forfeiting? See, here, if I tell you one thing, that what is the meaning of this factoring? Factoring is basically a type of facility in the export and import thing, and the difference of this factoring and forfeiting that lies in the risk assumption and recourse. Factoring can be done with recourse or without recourse. In recourse factoring, exporters bears the risk if buyer default, and in non-recourse factoring, the exporters assumes the credit risk. But what is the meaning of this factoring? What is the meaning of this factoring? Factoring is a type of method where business sells its unpaid customer invoices to a third party at a discount and gets the immediate cash to improve the cash flows, instead waiting for the customer payments. So forfeiting is always without the recourse. Forfeiter here assumes the full risk of non-payment from the importer, and it is backed up by the letter of credit, bill of exchange, or promissory notes. So that's why we can say that factoring allows recourse option while forfeiting only has without recourse. Right? Now, export financing is designed to make finance available to export at what kind of interest rates? Four options are given. Which option is correct here? See, this export financing is designed just for the exporters, right? Why? So exporters can get the support and they can compete globally, right? And to achieve this, whatever the finance provided is offered at the interest rate which is comparable to those which are available in the international market, which can include pre-shipment finance and post-shipment finance. And it ensures that Indian exporters are not at a disadvantage. Why? Because due to high domestic borrowing cost. So here we can say that according to the option, internationally comparable interest rate is the correct answer here. Now I am giving you some questions in homework. Just read the questions carefully and do these questions and do the comment down, and also write about that you need theory or MCQs. So you can tell me this thing in the comment section. To start our unit 6, external commercial borrowings and the foreign investments in the India. So let's start with the class here. Let me give you the overview of the external commercial borrowing first. What is the meaning of external commercial borrowing? It is one of the important chapter and also contains some complexity in this chapter. So let's read every concept related to the external commercial borrowings. Basically, it refers to the loan, bonds, and other financial instruments which is raised by eligible Indian companies from recognized foreign lenders, allowing the access to the international capital for the expansion, infrastructure, or capital goods. And it is regulated by the India's RBI. ECB provides cheaper funding than the domestic sources and also follow guidelines on end users through automatic or approval routes. That is the concept of ECB. It is a type of loan basically, right? So if someone asks that what is the meaning of ECB? It is a commercial loan which is widely used by eligible resident entities who raise ECB from recognized non-resident entities. Right? Now, what is the meaning of ECB? ECB means borrowing money from outside India in the foreign currency or INR by the Indian eligible entities under the RBI guidelines. It is borrowing the money from outside India in the foreign currency or the INR by eligible Indian entities under the RBI guidelines. So when an Indian company takes a loan from a foreign lender, it is called ECB. When an Indian company takes a loan from a foreign lender, it is called ECB. So, like an Indian manufacturing company borrows US dollar, just a second. What is the meaning of ECB? It means borrowing the money from outside India, uh, like loan from the outside India in the foreign currency. An Indian manufacturing company borrows US dollar 10 million from a bank in the Singapore, that is called ECB, right? That is called what? ECB. Now, who are the eligible borrowers of this ECB? Who can take the ECB? Only the certain entities are allowed to raise ECB. Only the certain entities that are allowed to raise the ECB. Who are these entities? So here, first one is all the eligible entities who are receive FDI, or the all the entities which are eligible to receive the FDI. This means any Indian company that is allowed to receive FDI can also raise ECB. Here we can say that this means any Indian company that is allowed to receive FDI, they can also raise ECB. Example, IT companies, manufacturing companies, pharma companies, and also infrastructure companies. So all the entities which are eligible to receive the FDI means any Indian company that is allowed to receive FDI that can raise ECB. Now, startups that is recognized by the central government. Only the DPIT startups can raise the ECB, right? Only DPIIT recognized startups that can raise the ECB, right? That what is the meaning of this DPIIT startup? Basically, Department for Promotion of Industry and Internal Trade. uh, we can say, that is grant eligible new business benefits like tax exemption, easier compliance, and faster IPR processing. Now, only these companies, these startups are recognized to raise the ECB. Like a fintech startup registered with DPIIT raises $2 million from a US venture fund. Right. Now we have here uh, port trust units in the SEZ, SIDBI, Exim Bank. There are special institutions and infrastructure related bodies. A port trust borrowing from a Japanese bank to build a new terminal, or an SEZ unit borrowing to set up a new manufacturing plant. Exim Bank borrowing from World Bank. These all are the example of port trust units in SEZ, SIDBI, and Exim Bank. Now, registered entities who are engaged in microfinance activities. Microfinance institutions. Microfinance institutions who are registered in India, they can raise ECB. So, any microfinance institution from an international development agencies, they can lend to the rural women entrepreneurs, right? So, these are the eligible entities under the ECB, right? Now, eligible borrowers, sorry, and use of ECB. What is allowed, what is not allowed. RBI has given a negative list, meaning uses which are not allowed. So, first one, real estate activities, these are not allowed. ECB cannot be used for buying land, building houses, or real estate trading. That is not allowed, right? Then, investment in capital market, not allowed. Investment in capital, you cannot use ECB money to invest in shares, mutual funds, IPOs. A company cannot take ECB and invest in Reliance shares. That is not allowed, right? Equity investment, not allowed. Equity investment, you cannot use ECB to buy the shares of another company, right? So company A cannot take ECB and buy the shares of company B. That is not allowed. Now, working capital purpose, that is also not allowed except from the foreign equity holder. Basically, working capital means day-to-day expenses. Day-to-day expenses like salary, rent, raw material, right? It is not allowed generally, but allowed in the case if lender is foreign equity holder. So if a US parent company give loan to its Indian subsidiary for working capital, that is allowed. But if a foreign bank gives loan for working capital, that is not allowed. And apart from this, we have general purpose, corporate purpose. It is also not allowed except for the from the foreign equity holder. Here, general corporate purpose means routine business expenses. Routine business expenses, right? And allowed it is if only money comes from the foreign equity holder. Then repayment of rupee loans. that is also not allowed except for foreign equity holder. You cannot use ECB to repay Indian bank loans using the ECB unless the ECB is from the foreign equity holder. If Indian company repays SBI loan using money from its UK parent company, that is allowed. But if repaying someone SBI loan using money from German bank, that is not allowed. And all the above activities, all lending for all the activities above which is not allowed, you can't borrow ECB and lend it to the others for the prohibited activities. So in NBFC, they cannot take ECB and they can't lend it to the real estate company, right? Now, who are the recognized lenders? Who are the recognized lenders who can give the ECB? Residents of FATF or ISO compliant country, the lender must be from a country that follows international financial standards like USA, UK, Japan, Germany, Singapore, that is allowed. But those countries which are blocklisted by FATF, that is not allowed. Right? So then we have multilateral and regional financial institution where India is a member, that is allowed. Like examples, World Bank, ADB, IMF. Individuals only in specific cases. Individuals can lend if they are foreign equity holders for the subscriptions to bond, debentures, and who are listed abroad. Like a foreign promoter gives loan to his Indian company, that is allowed. Foreign branches, subsidiaries of Indian banks, that is allowed only for foreign currency ECBs. SBI London branch lending in US dollar to the Indian company, that is allowed. And what is the meaning of minimum average maturity period? This means minimum time period for which the loan must be kept before full repayment. What is the general rule? 3 years. Most ECB must have the minimum maturity of the 3 years. Right? And for the manufacturing sector, 1 year up to US dollar 50 million. Manufacturing companies can take ECB up to US dollar 50 million per year with 1 year maturity. Repayment of rupee loans. If ECB is used to repay non-capex rupee loans, so the maturity is 5 years. But the thing is there, what is the meaning of this non-capex rupee loan? Non-capex rupee loan. So basically this term means that you can say this is a type of loan in the Indian currency which is used to cover some operational and general expenses rather than purchase of major capital assets like land, building, or heavy machinery. They are typically referred as personal loans, working capital loans, operational expenditure loans, and they are generally unsecured. Right? Then working capital and general corporate purpose. In this case, we have 10 years. If ECB is used for working capital and for general corporate purpose, so the minimum maturity is only 10 years. And if rupee was taken for capital expenditures like plant machinery, the ECB used to repay with a 7 years maturity. And if rupee loan was for non-capex purposes, then the maturity is 10 years. Okay. For startups, minimum maturity 3 years. startup who borrows $1 million from a US investor, they must be at least for 3 years. Now let's see some examples that will help in understanding this ECB concept clearly. Let's see the allowed case first. Suppose if an Indian pharma company borrows $20 million from a German bank to buy the machinery, right? So, is this eligible borrower? Yes. And here capital expenditure allowed. Then FATF country allowed. So maturity will be 3 years and ECB is permitted in this case. Got it? ECB is also permitted in this case. Now, we can take one more example here. Suppose a real estate developer borrower who borrow $5 million from Dubai bank to build the flats. So real estate is obviously not allowed. ECB is not permitted, right? And if Indian companies take ECB from its US parent to pay the salaries, so working capital normally not allowed. A lender is foreign equity holder, but this thing is allowed, so ECB is permitted. Now, all-in ceiling cost. All-in cost means total cost of borrowing for the ECB, not just interest. Total cost of borrowing. For the ECB, what is the total cost? Not just interest. It includes rates of interest, other fees, expenses, charges, guarantee fees, export credit agency charges, whether paid in foreign currency or INR. It does not include any type of commitment fee, any type of withholding tax which are payable in INR. So all-in cost means everything that the borrower pays to get the loan, except tax and the commitment fee. So an Indian company borrows 10 million from UK bank. Interest 6%, processing fees is 1%, guarantee fees is 0.5%, ECA charges is 0.25%. All these together, all in cost. So TDS paid to Indian government, that is not included. And commitment fees for unused portion, that is also not included. Right? Now, so why RBI is fixing all this all in cost? So first let's learn about the ECB. First let's learn about this, that why this RBI fixes this all in cost. All in cost ceiling. Why? Just to protect the Indian borrowers from overcharging. Then it also ensures financial stability, right? So we can say that after getting the loan, borrower have to report every transactions every month through the authorized category dealer one bank, and they have to reach the RBI within 7 months from the end of the month. They have to also reach to the RBI, they have to make the contact with the RBI, right? And what is reported? Amount drawn, repayment, interest paid, and changes in the terms. So in January, company draws $1 million, pays interest $10,000. By 7th of February, ECB2 return must be filed. Any change in amount, maturity, interest rate, end use, they must be reported in the ECB2 return. And if borrower is not doing reporting on time, they have to regularize it by paying LSF. Delay period can be up to 30 days, for 6 months, for 1 year, or even beyond 3 years. Penalty range must be 5,000 to 1 lakh. It depends how much the delay is there. Right? Is that clear? Now, what are the reporting requirements? What are the reporting requirements under the ECB? So, you can say ECB is tightly monitored by RBI. So, reporting is compulsory. First thing is most important, LRN, that is loan registration number. What is loan registration number? Before drawing ECB money, borrower must obtain this LRN from the RBI. Borrower have to submit Form ECB to the authorized dealer category 1 bank. Authorized bank forward to the RBI, this thing, that is Department of Statistic and Information Management. RBI is to issue LRN, loan registration number. Example, you can understand this thing. Suppose ABC Limited, which plans to borrow $5 million from Japan. Before receiving money, it must apply through its bank. RBI verify the details. RBI issues the LRN. Only then funds can be drawn. Only then funds can be drawn. So that is the complete system, complete process, you can say. Right? Now, FDI. What is the meaning of FDI? Foreign direct investment. FDI. Foreign direct investment. You can say that foreign direct investment is a type of investment which is made by entity in one country into a business or a corporation in another country, and at least typically they own 10% or more of the voting shares. So FDI means investment in the equity instruments by a person resident outside India or on a repatriable basis, that all the money can be taken back to the country. So when a foreign person or a company buys shares in Indian company to control or participate in business, that is called foreign direct investment. Example, Google invest in an Indian startup, Toyota set up manufacturing plant in India, Walmart invest in Flipkart. These all are the examples of FDI. So once FDI, always the FDI. If investment enters as FDI, it cannot be treated as domestic investment later. FDI is always the FDI. Foreign portfolio investment. The other uh, sibling of FDI, that is FPI, foreign portfolio investment. That refers to the investment in the foreign country financial assets like stock and bonds, rather than direct ownership. Rather than direct ownership. FPI registered under SEBI FPI regulation 2019. They can invest in shares, bonds, debenture, mutual funds. They can invest in primary and secondary market. Securities are listed or to be listed. They do not control any type of management. So our US mutual fund buys shares of Infosys from the stock exchange, that is called FPI. What is the main difference of FDI versus FPI? FDI is for long term, FPI is for short term. Control is there, but in FPI, no control is there. In FDI, management is involved. In FPI, only the investment is there. In FDI, strategic, everything is strategic, but in FPI, we have only financial. So what are the process of reporting? Various FDI reporting forms are there, because we know that strict reporting is required. Who files, why it is filed, when it is filed. First we have FCGPR. But before moving to the FCGPR, let's learn something about LSF. LSF. So here we can say that uh, if suppose company forget to file ECB2 return for 8 months, they have to pay late submission fee. RBI regularizes delay and no legal action if otherwise compliant. So delay in reporting can be um, like fulfilled by paying LSF, and that is the most important thing, right? Then we have one term which is a startup company. What is the meaning of startup company? Startup company can be private Indian company according to the Companies Act 2013, registered partnership firm, and LLP, limited liability partnership. It is again recognized by DPIIT. It is under Ministry of Commerce and Industry, Government of India. So that is basically the meaning of startup. And only recognized startups get tax benefit, ECB eligibility, funding benefits, and government schemes. Right? Now, let's learn about the forms. First, we have FCGPR, foreign currency gross provisional return. Foreign currency gross provisional return. So, what is the purpose of this? Reporting issue of shares, capital instruments to a person who are resident outside the India. It reports conversion of ECB into equity. Who files? Indian company who is receiving investment. What is the time limit? Within 30 days from the date of issue of capital instruments. So if an Indian startup shares issue the shares to the US investor on 1st of March, so FCGPR must be filed by 31st of March. And if ECB loan is converted into the equity, so FCGPR is used to report that conversion. Then we have FLA return. FLA return. Foreign liabilities and assets. What is it? Annual return showing that all the foreign investment received and all the foreign investments made. Who can file? Indian company and LLP, they can use the FDI. And when? On or before 15th of July every year. So FLA is mandatory every year once FDI is received, right? Then FCTRS, which is used for transfer of shares between resident and non-resident, buyer or seller through authorized dealer bank within 60 days of transfer or receipts of funds, whichever is earlier, and it report every transaction separately. ESOP, Employee Stock Option Plan, which is issue for stock options to person resident outside India. Who can file? Indian company. What is the time limit? 30 days from the date of issue. So if Indian IT company give ESOPs to its US employee, and it have to be report within 30 days. Right? Then we have some LLP Form 1. What is the purpose of LLP Form 1? When LLP receives capital contribution and profit share consideration, who can file LLP? Indian LLP. And what is the time limit? 30 days of receipt. 30 days of receipt of amount, right? And apart from this, DRR, depository receipt return, it report issue and transfer of depository receipts within 30 days of close of issue and program. Downstream, when an Indian company with FDI invest in another Indian company, who can file? Indian entity within 30 days of such type of investment. Now, who are the eligible foreign investors? Person resident outside India, NRIs, OCIs, and foreign nationals. NRIs who are in Nepal and the Bhutan. Overseas corporate bodies, FPIs, foreign venture capital investors. They are the eligible foreign investors. And what are the prohibited sector for the FDI? Lottery business, casinos, chit funds, nidhi companies, trading in TDR, real estate business, manufacturing of tobacco and cigarette, sector which are close to the private investment. So, if foreign casino opens in Goa, that is not allowed. If US company sets up a cigarette factory, not allowed. Japanese firm invest in Indian IT company, allowed. UK fund invest in real estate trading, not allowed. Um, then, yeah, this you can learn that LSF, if amount is up to 1 crore, so only 0.05% of amount is applied. 10 lakh or 300% of the amount involved, whichever is lower is the maximum one, right? And here, when amount involved is more than 1 crore, so LSF rate is 0.15%. 1 crore or 300%, whichever is lower. So LSF percentage doubles every 12 months of delay. Sundays and holidays are included while counting delay. The delay period is counted from the day after the due date up to the day before actual reporting, right? And also, who are the eligible investees here? Who are the eligible investee entities who can receive FDI? So, who are the eligible investee entities? First one is our Indian companies. According to the Companies Act 2013, like private company, public company, SEBI, LLP, special investment vehicle, startup companies. And who are the eligible instruments? Fully paid up equity share, partially paid up equity shares, and fully and like compulsory convertible debentures, and convertible notes, bonus shares, import of capital goods, and conversion of ECB into equity is allowed if sector receives the permits the FDI.
Risk in foreign trade, role of ECGC. If I told you that what is the meaning of foreign trade, buying and selling that takes place between exporters and the importers, and it is very important to support the exporters. So basically, what they can do their business in a very smooth way, right? But what is this ECGC? What is the meaning of this ECGC? That is Export Credit Guarantee Corporation of India, which is a government owned agency under India's Ministry of Commerce that supports Indian exporters. How? By providing risk insurance against non payment from foreign buyers. So it is basically a type of support for the exporters so they can do their business without any problem. That is basically what? That is the meaning of the ECGC. ECGC work is just the exporters by providing them finance and everything, right? So today we will learn about this chapter in a very quick manner. So let's start with the class. I am hoping that everything is fine from my side. I am audible, my screen is visible. So what is the risk? Risk is present everywhere. In humans' life, risk is there. In businesses, risk is there. And it is also there that high risk means high chance of return. So risk means when the expected results are completely different and some unexpected events are occurred. That is called risk. That is basically different from whatever predicted or whatever expected. And that can be give loss or profit. And in the case of international trade, risk is very high because buyers and sellers are in the different countries. There are different laws, currencies, and also the political systems. There is a long distance and time gap between shipment and the payment, right? So we can say that there is a problem also present in the international trade, that is risk. Okay. If an Indian exporter ships the goods worth $1 million to a buyer in another country, if that buyer fails to pay due to bankruptcy or political issues, in that case, obviously, exporter suffers a loss. To support the exporter, there is the agency called ECGC. But without ECGC, it is a risk for exporter. What are the types are there of risk in the international trade? First one we have credit risk, and we also call this as a commercial risk. Credit risk is the risk in which the foreign buyer they may not pay the exporter fully on time. When the buyer defaults on doing the payment, that is called the credit risk. And problems can be there with the buyer too. Buyer become insolvent, buyer become bankrupt, buyer willfully doing the default, or any type of business failure. So that is called the credit risk, which is generated from the buyer side. So if suppose exporter sells goods and gives on a credit of 90 days, let's do my payment after 90 days, but after 90 days, that buyer defaults or buyer company become insolvent. So exporter lose the entire amount in that case. So that is a problem for exporter, right? And this is the type that is called commercial risk. What is legal risk? as the name is legal, when the changes are there in the rules and regulations, either in the importer's country or either in the exporter's company, both changes, both countries' changes affects the rules and regulations. So, export restrictions imposed by seller's country, import ban by buyer's country, foreign exchange control regulations, sanctions or trade embargoes. So, all these creates the buyer or the exporter. Exporter ships machinery, but before payment, buyer country introduces a law that prohibits that no money will send abroad. So obviously that will create the problem for the exporter because buyer is not able to pay for the shipment. That is called legal risk. Right? Now we have third risk here, which is called country risk or political risk. What is the meaning of country risk or political risk? Where country risk refers when the risk arises due to economic, political, or any type of social conditions in our country that directly affects the trade, or payment. So political risk, we can include any type of war, any type of change in government, nationalization of the industries, or some types of problems that will obviously create this problematic situation for the buyer to do the payment, right? Suppose we can say that there is an exporter who sends goods to a political unstable country and war breaks out there. Banks stop operations, so payments are blocked now. So that is the loss for the exporter. So that is called basically the political risk, right? Then we have operational risk. Completely operational risk means when the loss occurs due to people, process, and some external events which are not in the control of the banks. That is called operational risk. Now, you can take the example in the operational risk that arises just because of failure in the processes, system, people, or external events. And suppose there are documentation error, there is delay in the shipment, port strikes are there, courier failure, shipping line failure, bank failure, system failure in the banks. All these are the examples of the operational risk, right? Okay. Now, what is the meaning of exchange risk? Foreign exchange risk when there is the worst movement in the foreign exchange rates. Example, suppose export contract value is US dollar 1 lakh and at the contract time exchange rate is 83 per rupees per dollar and payment time it become only 80. So that is the loss because exporter receives here the less money just because of this exchange rates fluctuations that is called foreign exchange risk and that caused the loss, right? So country risk, I hope that you are clear that if any economic, political, social changes are there in the country that affect the payment or the trade, that is called the country risk, right? Now, what are the factors while assessing the country risk? What are those factors that are helpful in assessing this country risk? Banks or financial institutions, they are evaluate the following factors. First, political stability. They will check that is there any political stability or any type of instability occurs. You can say that stable government reduces risk, frequent changes increases the risk. Then they check the international relations because we know that poor relations with other countries they may lead to the sanctions. Then economic policy, Economic policy is also a factor that helpful in assessing the. And what is the economic policy? That sound fiscal and monetary policies are good. That will improve the confidence. And most important thing is GDP, gross domestic product. Higher GDP means there is stronger economic capacity, right? Then inflation or exchange rate volatility. Why the inflation? Because high inflation obviously that reduces the purchasing power and also the stability. But exchange rate volatility, if there is very high movement in the exchange rate, that will create loss in the in while doing the payments, and some type of external debt or balance of payments, right? So it is important to basically, if deficits are there, so that will obviously show the payment difficulties. And if any country is in high debt, that will obviously there is the risk of default, right? And most important thing is that international rating and the records. International rating and the records means rating by the agencies, they will indicate the credit worthiness. And if there is any history of defaults in the documents or in the records, that is the indication of the risk, right? So that is basically we can say those factors are very helpful in assessing the country risk. Is that clear? Okay. Now we can say that international trade involves multiple risk just due to cross-border transactions, because transactions are not happening in a domestic area. Transactions are international. That will definitely create the problem. So, understanding different types of risk and using the tools like export credit insurance, that will help the exporters and the banks in minimizing the losses and promote global trade safely. Clear that thing? Okay. Now, export credit insurance in the international trade. So export credit insurance that protect exporters and banks against the losses which is arises from the commercial and as well as from the political risk. So there is the insurance for the exporters that protect the banks and exporters, which where losses are arising from commercial and political risk, right? Now, risk covered. What are the risk covereds? Buyer's insolvency, protector default, war civil disturbance, government actions that blocking the payment, right? And what is the benefits? That reduces the risk of non-payment, that encourages the exporters basically, and uh, so exporters will enter into the new market without any problem, and also enables the banks to provide export finance confidently. So, export credit insurance is like a great thing for the exporters. They can do business without any issue, right? Is that clear? Now, let's see now that what is this ECGC? This is the organization, government organization that provide Export credit insurance. And what are the key features of ECGC? Government of India undertaking that supports Indian exporters, that covers both commercial and political risk, that provides insurance to exporters and the banks. So, if an exporter defaults due to the bankruptcy, ECGC compensates a major portion of the loss. Clear that what is the meaning of this ECGC and how this is very useful for the exporters, right? Okay. So that is the Government of India undertaking which provides credit insurance guarantees to the Indian exporters and banks. Earlier, it is known as Export Credit Guarantee Corporation Limited. Now it is called Corporation of India Limited. It just the main work of this uh, undertaking is just to support the exporters just because from the financial losses which is arises from bank failure to pay, political or economic problems in the importing country, right? So what are the objectives of this ECGC? What are the objectives of this ECGC? Okay, first main objective, you can just think that to just help the exporters. So exporters can do their business without any issue. That is the main thing. That is the main objective of this ECGC that works only for exporters. It encourages globalization. It encourages the globalization basically by reducing payment risk. Exporters are encouraged. They will explore new and risky international markets and they assist the Indian exporters. They advise the Indian exporters that how to manage the um, basically India's trade, right? ECGC help the exporters that deal with risks such as buyer default, insolvency, or delayed payment, and also protect the Indian exporters against any type of unforeseenness. That's why the ECGC is there to help the exporters. If they are like hopeless anywhere, they are not getting payment, they are struggling. So in that case, ECGC help the exporters, right? And also they facilitate the availability of bank finance, right? Availability of bank finance is there. They want to achieve improved performance. They develop world-class insurance and also they educate the customers, right? So that all are the purpose of this ECGC, which is a governmental organization just for helping the exporters. Is that clear? Now, what are the main activities of this ECGC? That insurance covered to exporters, different types of credit insurance, the export facilities, factoring facilities for the MSME sector. They provide credit risk insurance. They provide insurance to the banks and financial institutions. And also, they uh, export finance guarantee and transfer the guarantees. So, let's see now what are the ECGC policies. So, here, first let's learn about standard policies. For those exporters who are doing export only for a short term, where credit period is generally up to 100 days, 180 days only. So in this, they cover shipment, right? They cover shipment those shipments, those occurs just due to the political risk. And I hope now you are aware that what is political risk. Then contracts comprehensive risk policy, which also covers commercial and political risk, and it starts from the date of contract. Contract political. So there is two types. For political risk, different policy. And what are the risks covered under the standard policy? Commercial risk. What is the meaning of commercial risks? Buyer insolvency, default, failure to take the delivery, then repudiation. What is the meaning of repudiation? Where the buyer fails to accept or refuses to accept goods or denies liability without any valid reason. Right? Then political risk. What political risk? Obviously, any war situation and any import restrictions, any currency transfer restrictions, these all are the type of the political risk. Clear? And what are the risks that are not covered under the standard policies? First, does not cover any type of commercial disputes. What commercial disputes? If buyer raises dispute that goods are not good, goods are not up to standard, that are not covered in this. If any type of risk occurs due to the inherent nature of the goods, means if goods are perishable and there are inherent defects and natural deteriorations are there, so that type of goods are not covered under the ECGC. Perishable means like milk type things which are basically consumed in 1 2 days, these type of goods. And if there is default or insolvency of any agent, right? Apart from this, exchange rate, fluctuation risk, and if exporter fails just to fulfill the contract terms. So ECGC is playing a very good role in safeguarding just Indian exporters and banks against the international trade risk. And it is a comprehensive policies guarantees which make it a key pillar in India's export promotion strategy. So ECGC is a booster for the exporters, right? Then we have here small exporters policy. As we know that there is the policies for the exporters just to support the exporters, and in which those exporters whose turnover does not exceed 50 lakhs for the next 12 months. And in this, if the policy covered insolvency of the buyer is not able to pay within 2 months from the due date, buyer failure to accept the goods, but some risks are not covered in this small exporters policy. If there is a dispute between the buyer and seller regarding goods are not appropriate and all these things, if the causes just because of perishability nature of the goods, buyer fails to obtain import or exchange authorization, insolvency or loss or damage of goods. So the same thing is there. Now, specific shipment policies. These are issued to cover individual export shipments. Individual export shipments. These policies are useful when exports are occasional. Exporter does not want an annual policy, they just want up insurance for a specific shipment, right? So, what are the types of short term specific policies here. First thing, there is the specific shipment policy. Specific shipment policy that covers political, that basically covers uh, commercial or political risk, right? Then specific shipment policy, which is related to the political risk, right? And it covers only the political risk, right? Then we have specific shipment policy. And in this specific shipment policy, we can include insolvency and default of LC. Basically, if there is default of the LC opening banks, political risk are there, insolvency of the LC opening bank, that will covered in this. But losses are the same, which are not covered in the last two policy. In this policy, losses are not the same thing. So you can say small exporter policy is just for the small exporters whose turnover does not exceed 50 lakhs, and specific shipment policy, which covers commercial plus political risk policy, where the political risk are included, and LC bank default policy, where the LC bank default plus the political. Right. So, in short, we can say the small exporter policies and specific shipment policies of ECGC are just to design to address the specific needs of the exporters, especially those MSMEs, occasional exporters, because this policy helps in reduce payment risk and strengthens the India's export framework. So, now, how you can differentiate in these all types of policy? For this, what you can do, I also help you in this. In the notes, I will upload a table. You can create a table in your notes where you can write the all policies that will help you to determine that which type of policy is which type for which exporter basically, right? So that will help you out to understand the difference of policy. Policies are very easy, but they are confusing if you are not writing yourself. So it is important to write the policies by yourself in your notes. That will definitely help you. Okay. Now, exporters policies for the specific buyers. This policy is just taken for the particular foreign buyer. Particular foreign buyer means it protects Indian exporters against any type of non-payment risk when goods are exported on a short-term credit. In this, commercial risk are covered, political risk are covered. So there is also the buyer-wise policies. Buyer-wise policies where it covers the buyer's failures. Political risk policy specific buyer-wise political policies there, and buyer-wise commercial and political risk policies there. In political risk policy, it covers only the political risk. And also, you will see that the same thing is there, but now it included only the buyer-wise. So involves insolvency and default of LC opening bank, that is also having the policy where it covers insolvency of the buyer, default by the bank that opened the LC, and the political risk. The most important is buyer exposure policy. The most important. What is the meaning of buyer exposure policy? So, um, this policy, first thing, is designed for the large exporters, right? Who regularly deal with the high value buyers. Instead of insuring each shipment, ECGC ensures the maximum exposure expected exposure on a file, right? So, in this we have different types of policies, like single buyer policy, which covers only the specific buyer, multiple buyer exposure policies, which covers all the buyer together, and uh, again, export turnover policy. It is only for the large exporters which are having high export value volumes, and minimum annual premium contribution is 10 lakh. And here exporter projects annual export turnover, premium calculated at the beginning, and final adjustment made after the year, which is based on actual export. So if an exporter estimates export of 100 crore in a year, so premium paid on 100 crore, actual export turned out to become 110 crore. And what is the additional premium? That is 10 crore. Very simple. It saves time, suitable for exporters. Then consignment export policy, when the goods are not sold immediately, but they sent abroad and then they sold that later. That is called consignment exporters policy. Exporter faces risk here because ownership remains with the exporter until the final sale. Clear? Now, what is the meaning of export finance guarantee? Banks finance the exporters. They give a loan to the exporters if they do any type of post shipment, such as cash assistance and duty drawback. But what is the meaning of this term, that is duty drawback? Duty drawback basically a type of a program by the government that refund taxes which are paid on the imported materials and which are used to manufacture goods for export. So that make the exporters competitive globally, right? So if exporter is due 10 lakh export incentive, banks give post shipment loan against it, government scheme is withdrawn, ECGC covers the bank loss. Then export performance indemnity means export. Uh, Basically, indemnity we can say exporters need to submit the guarantee for the performance, right? Exporters are required to submit guarantees for the performance, quality, bid bonds, or custom obligation. Bank issue these guarantees on behalf of the exporters. This is a counter guarantee which is issued by the ECGC to the banks. Bank issue guarantees on behalf of the exporters. And how many types of guarantees covered? Performance guarantee, bid bond guarantee, advance payment guarantee, quality guarantee, every type of guarantee. And when the Indian bank finance the overseas projects, they may also give foreign currency loans to the contractors. And this guarantee protect the banks against non-payment by the overseas contractor. And here also the ECGC factoring services are available. And in this ECGC factors, what we can say that ECGC provides export factoring, which is a complete financial and risk management solution. What type of services are provided? Purchase of export receivable, up to 90% immediate finance, 100% credit guarantee against buyer insolvency or default. And Sales ledger maintenance, collection and follow up of all the export proceeds. Right. But one thing is there which I have to tell you about the claims. Now, what is the meaning of the claims basically? Some common due to points we can say for the exporters under the ECGC policy. First, they have to check the policy validity. Policy validity means where exporters have to ensure that the policy is valid and it covers all the shipments. Renewal should be applied well in advance, right? Maximum liability. Maximum liability means which basically maximum liability under the policy should be sufficient to cover total outstanding export at any time. Premium payment, where adequate advance premium must be maintained. Installments, if allowed, must be paid on time. And claims must be filed after the declaration of overdue declaration, that basically within the 360 days from the due date, right? And exporters, they have to continue recovery actions as well as under even after claim is filed or settled. And if buyer requests extension of payment period, in that case, ECGC approval is mandatory. An exporter should not enter in any type of compromise settlement, or they are not allowed to offer the discount without the ECGC approval. So everything must be in the knowledge of the ECGC, right? Um, then we will cover this IT enabled service policy for the single customer, that we can say sites. Okay, what is the meaning of this? Basically, policy, which is very important for exam point of view. So, this policy is for those exporters that provide IT and IT enabled services to one specific foreign client. One policy is allowed for one buyer. Policy period is 12 months and billing must be weekly, monthly, or quarterly. It covers all the services which are rendered over the time. So this policy is for the IT IT enabled services. In this, commercial risk are covered, political risk are covered, and LC offering bank risk are covered. So if an Indian company that maintains IT company provides software maintenance services to the US firm, so in this monthly billings are there, US firm default on payment, so ECGC compensates under the sites policy, right? And what are there is the policy available for the SME sectors. Basically, this policy is designed for the SMEs, small and medium enterprises, which is defined in the MSMED Act, which comes in 2006. Here, exporters have to engage in manufacturing in the services and they have to qualify as a MSME under the MSMED Act. But policy period is only for 12 months. It covers commercial risk, political risk, and it also covers 90% of loss. right? So suppose there is a small textile exporter that export fabric to the Bangladesh. Buyer fails just because of insolvency. There is the loss of 10 lakh. So ECGC pays 9 lakhs here. So it is very advantageous for the SMEs because high coverage is there, premium is very low, and it encourages small exporters to enter into the global market. To start our Unit 9, IFSC Gift City. Yes, Pongal holidays are there, family time, and very important. Family time is most important. So today we will discuss about very easy chapter. That's why we opt a easy chapter for today, IFSC, International Financial Service Center, Gift City. Okay, so what is IFSC? If I give you the overview of IFSCA, it is India's unified regulator for the financial services like Gift City, and they are aimed to create a global financial hub by developing and regulating banking, capital market, insurance, and more. And they also promote the business in a very easy manner. Capital market, insurance, and also innovations are there. Investor protection is there. So that is why the IFSC become a very, a growth concept which develops IFSCs as a major financial platform at international level. They provide a consistent global benchmark regulatory framework and also enhance the global competitiveness of the Indian financial services. Right? So we will learn today some things, some concepts about this IFSCA today in this class. So let's start with the class. So first thing is this is a special area in a country that provides financial services to the clients who are located outside the India. IFSCA is a special area in a country that provides financial services to the clients who are outside the country. It is a place in India where banks and financial institutions do business as if they are operating in a foreign country. So customers are mainly non-residents, foreign clients. Transactions are mostly in the foreign currencies. It connects India with the global financial market. So obviously it is very helpful for Indians too, Indians businessmen, Indians exporters, Indian importers. It helps everyone. So if a company is there in the Singapore, want a loan in US dollar, it can take the loan from the bank branch that is located in the IFSC instead of going to London or Dubai. That is the work of the IFSC, right? That is the concept of the IFSC. Now, if I ask you that, okay, why the IFSCs are needed? Why we need this IFSC and why our countries, our country is too much crazy about these IFSC because growths are banks are also wants to collaborate with the IFSCs. They are working with the IFSCs because IFSCs bring global uh, business into the India, global financial business into the India. Second thing, it reduce the India's independence. It reduced India's independence on financial foreign hubs like London, Singapore, and Hong Kong. It also provide a platform for foreign currency. It provides a platform for the foreign currency transactions which are happen in the India. And also it supports the Indian companies and as well as economy, the most important. So that's why we need IFSC in the India. What are the major activities of the IFSC? First major activity we can say fundraising services, because it helps individuals, it helps companies, governments, because it helps individual companies, governments, so they can raise the money from the international markets, right? How? Through the bonds, loans, equity in the foreign currencies. So if the government of India wants to raise US dollar 1 billion, it can issue bonds through the IFSC. If an Indian company wants to expand in Europe, it can raise funds in euros through IFSC. Got it? Now, second is asset management and global portfolio diversification. It manages the investments of very large institutions. Large institutions uh, like pension funds, insurance companies, or you can say mutual funds, because they invest their money in different countries and also the assets. Why? Just to reduce the risk. And they do not pull the eggs in the one basket. They invest in many countries, that reduces the loss. So if a pension funds invest 30% in US stock, 20% in European bonds, this is completely managed by IFSC. Then wealth management. Wealth management, how? It manages the wealth of high net worth individuals. Basically rich individuals, in which they are doing investment planning, tax planning, also they do the planning of estate and retirement planning, right? An example, if an NRI businessman, they wants to invest, they have the 100 crore, they wants to invest globally. So IFSC helps in save tax, plans the inheritance, and that will help the individual to manage the wealth carefully, right? Now, that is the also the wealth management is also a thing. Now, next we have global tax management and cross-border tax optimization. Global tax management and here um, cross-border tax optimization means helping the clients legally to reduce the burden, tax burden, while doing business across the countries, right? And who benefit from it? Obviously, MNCs will get benefit, rich individuals, investors, global investors. And who provides this? Financial intermediaries, chartered accountants, law firms. So, suppose if a company earns profit in three countries, IFSC expert structure the transaction so the total tax paid is minimum but legal. Got this thing? Okay. Now, here, corporate treasury management. What is the meaning of corporate treasury management? Meaning that management of a company, whatever from cash, loan, investment, assets, and liabilities. And what are the functions of the corporate treasury management? Raising the funds, liquidity management, asset liability mismatching. If a global company has income in US dollar but expenses in the euros and loans in the yen, so IFSC Treasury Services balance all these things. That is the corporate treasury management, right? Risk management, one of the most important feature of all the financial institution, that is risk management. Risk management is uh, we can say that risk management is the
Insurance, managing the risk through the insurance and reinsurance, like insurance of the insurance companies. So there is no risk. If an airline insures its aircraft, that means insurance company further insures that risk through the reinsurance in the IFSC. So risk management, how they do the risk management? By the insurance and then reinsurance. Mergers and acquisitions, helping the companies so they can buy the another company. When one company is buying the another company, that is called acquisition. But when one company combined with other, that is called merger. So if an Indian IT company wants to buy a US firm, IFSC investment bank manage this deal. That is the merger and acquisition. Is that clear? That what is the functions basically having in an IFSC? Okay. Now, these are the merger and acquisition functions of the IFSC. But what are the objectives of the IFSC? In the India, objectives of this IFSC in the India. Lots of objectives. Basically, first, building the global financial connections. That is one of the most important thing. Building global financial connections. Then support the Indian economy. Obviously, it supports Indian economy. And it attracts the foreign investment. That are the objective of the IFSC. So we can say that in the IFSC in the India, banks in the IFSC are treated like foreign banks. They are not mandatory to maintain the CRR and SLR. They can accept deposits only from the NRIs. They can lend, they can borrow to the NRIs. So in NRI, they can open their account in the IFSC bank where a resident Indian cannot. Banks in the IFSC can lend in foreign currency to non-resident to resident corporates. Why? To the resident corporates? Just for the trade transactions. So if an Indian exporter needs US dollar to import the machinery, IFSC bank can give loan in the US dollar. Right? Now, one more thing is here, that is SEZ Act, Special Economic Zone Act, 2005. And basically, as per the SEZ Act 2005, IFSC can be set up in a SEZ unit, can be set up in within an SEZ unit, or it requires approval from the central government. So why this special economic zone is used for IFSC? Because India has partial capital account convertibility, highest SLR requirements, and also maybe restrictions on foreign investment. So this SEZ act as a testing laboratory for the financial reform. So if a new banking rule works well in IFSC, it can be later applied to the whole country. And as per the Finance Act 2024, according to the Finance Act 2024, no securities transaction tax for the non-residents which are trading through the IFSC. And the benefit of this, it reduces the cost of trading and it also attracts the foreign investors. But the thing is there, what is this STT tax? Securities transaction tax. This is the direct tax in the India on buying and selling listed securities like shares, derivatives, equity, mutual funds on recognized exchanges. And basically this tax is collected by the brokers on the behalf of the government. So that is the meaning of STT. It is a direct tax. And this tax is applied on buying the securities. Right? That is the meaning of STT. Okay. Now that thing is clear. Now what is the gift city? Gift city is there in the Gandhinagar, Gujarat. Gujarat International Finance Tech City, that is in Gujarat, Gandhinagar. It start functioning on 5th of December 2019. It is India's first and only IFSC in current time. And what are the institutions are included in this gift city? Public sector bank, private sector bank, foreign banks, fintech companies, insurance companies, asset management firms, that makes a complete financial ecosystem. So in this one, the different thing is that fintech. What is the meaning of this fintech? Can you tell me that fintech? Fintech is the short form of financial technology, which is there just to improve and delivering the financial services on time. That is the fintech company, right? What are the opportunities at the gift city available? First, there is the access to the large hinterland economy. Large hinterland economy. Because we know that India has a lots of people, large businesses, growing middle class. So gift city connects global finance to this large market. And due to gift city, it builds connection in the international market. So there is the access in the international markets. Companies in the gift city can raise the funds globally, trade globally, invest globally without leaving India. And there are 30 million NRIs worldwide with a wealth of $3 trillion. So gift city connects their money to the India. So if an NRI who is in the USA invest in the Indian bonds, they can invest through the GIFT City. What is the meaning of inbound? Whenever the money is coming, and outward whenever the money is going abroad. So that GIFT City act as a financial bridge. Right? What is the meaning of GIC? Global in-house centers, where large companies, they set their internal finance centers in the GIFT City. Why? Because it offers everything in lower cost, skilled manpower is there, and there are global standards. And GIFT City is designed as world-class fintech hub, modern infrastructure is there, and international work environment is there that attracts bankers, analysts, and as well as the fintech experts. Right? And this is the hub for fund administration. Hub for fund administration means it includes all the things should be according to the rules and regulation. Reporting should be there, everything should be reported. GIFT City is emerging as a global center for fund back office operations. So here we can say that IFSC means International Financial Business Zone, or clients are here mostly non-residents. Currency, foreign currency. Objective, just to make the India as a global financial hub. Legal basis, SEZ Act 2005. India's IFSC is there in the Gandhinagar, Gujarat. And benefits are there. Obviously, there are tax benefits, financial benefits, global access is there. Got that thing? Now, the thing is there, that is all the thing we have, that what is the meaning of this all this thing. Now, what are the key business opportunities are there in the IFSC? IFSC offers a wide range of financial services which are broadly divided into wholesale banking, capital market, retail banking, treasury management, and also some other opportunities are available here. Now, let's discuss one by one. First, we will discuss about wholesale banking. Wholesale banking means large value transactions, and corporate clients are there, no individuals. In which external commercial borrowing, it is a type of loan which is taken by the Indian eligible companies from the foreign lenders. And companies can borrow also through IFSC instead of going abroad. So if an Indian infrastructure, they want to borrow $100 million, they can borrow from the GIFT City IFSC. Right? And in the case of this wholesale banking, we can include that trade finance also there. Why trade finance? Because in this, it basically finance the international trade. How? With the help of letter of credit, bank guarantees, and the most important, factoring and forfeiting. What is it? Factoring and forfeiting, the most important concept. Factoring is selling the invoices to get immediate cash. And forfeiting is selling the invoices without risk to the exporter. And here also we can say there are international level of trade finance services. Means it helps in participating export import financing, supply chain finance, cross border payments, And also one more thing, aircraft leasing is available in this. Aircraft leasing means leasing the aircraft to the airlines. So there are the tax benefits plus global legal framework is also there. And syndicated loans facility means large loans are provided by the group of banks. Suppose 10 banks together give a loan to one borrower or a basically multinational company. Via the IFSC it is possible, right? And it also provides equipment leasing. Credit enhancement means improves the quality of the borrower and protection against the default, and it also shares the risk of large loan with the other banks. So that are the basically we can say opportunities are available in the IFSC. That's why the IFSC is that much popular, right? Now it is okay. Now we have the capital market. What is the capital market? We learn this thing in the LRS. What is the capital transactions there? Capital account transactions in the LRS. Can you confirm? Can you tell me that thing? That what is the meaning of capital account transactions in the liberalized remittance scheme? So comment down that what is the answer. So capital market, they are dealing with the investments, securities, funds and trading. Capital market deal in investment, securities, funds and trading. And in this first thing we have merchant banking. What is the meaning of merchant banking? Means IPO management, all the types of advisory, fundraising, trading and clearing members of IFSC exchange. Banks, they can be treated as trading members, they can be treated as clearing members. Also we can say here in this funding of alternative investment funds. Funding of alternative investment funds is also there. Means suppose an overseas investor invest in Indian startup via these funds in the IFSC, and they also take the custodian of securities. Custodian of securities means safekeeping of shares, bonds, etc. And what are the other opportunities available here? One is their retail banking, which deal with individual client, because retail is there. In wholesale we deal with the group of borrowers, but here in retail banking it deal with individual clients, especially high net worth individuals and NRIs. So personalized banking for the rich clients, and also helps in the wealth management, how to do the investment, tax planning and estate planning. As I told you this thing, what are the retail banking products? Structured deposits, deposit accounts, certificates of deposit. What is the meaning of structured deposit? That return linked to the market performance. Whatever the market performance is there, that depends what is the return. And certificate of deposit is a type of short time investment instrument, right? Treasury management, a complete module is there on treasury management. Basically it deals with the management of assets and liabilities with risk management. So first, matching the assets with the liabilities, and it avoids any liquidity problem. What is liquidity problem? Not having enough cash available with the banks, and also the interest rate risk. Then derivatives are very useful to manage the risk. Swap, derivative options, credit derivatives, group wise derivative trading means large group mainly manage all the risk through the IFSC. What is the meaning of non-deliverable forward? A very important term. You will see these in the question in module C and module D. That is the non-deliverable forwards. Can you tell me that what is the meaning of this non-deliverable? See, these short type of concepts we must know, right? So these contracts are the cash settled financial contract, which basically used to hedge against the risk, or we can say that where no physical delivery of currency happens. We know that in a forward contract is what, where we lock the price today but do the settlement in the future, right? So only profit and loss is settled. There is no physical delivery of the currency, only profit and loss is settled. So this is used for those currencies which are having restrictions. If a foreign investors hedges the INR risk using NDF in IFSC, that is a opportunity available in the IFSC, right? So that is non-deliverable funds. Got this thing? Okay. And we can say that here one more thing, portfolio management services are also there. Portfolio management services. What is the meaning of portfolio management services? Portfolio management services means managing the client's investment portfolio. Managing the client's investment portfolio, where IFSC firm manages global portfolio of the INRI. And apart from this, there is the head office available for the regional operations. Representative offices are also there, and technically, operationally, cash transactions are not permitted, saving bank accounts are not allowed, only current accounts or term deposits are allowed. Know your customer, that means KYC and anti-money laundering norms are there. Deposits are not allowed in this, right? So basically we can say wholesale banking means large corporate business, capital market means fund, tradings and securities, retail banking means high net worth individuals, NRIs and deposits, treasury, risk management, derivatives and ALM, NDF is non-deliverable forward, IBU capital is about $20 million. We will learn this thing, we will discuss this thing also. And the most important thing now we will learn here, that IBU, IFSC's banking units are IBU, branch of Indian bank that are operating in IFSC. Who are able to set IBUs? Public sector, private sector, or authorized person who can deal in foreign exchange. Each bank can only open one IBU. So they have to take approval from the RBI. For the regulation, RBI is treated like foreign branch of Indian bank. It only follows foreign rules, no domestic rule. So parent bank provide minimum $20 million capital, which must be maintained all the times. So if SBI opens IBU, they have to keep at least $20 million capital. They are not able to maintain CRR and SLR. There is very low cost of funds but profitability is very high. Then resources and deployment. Here, resources and deployment, we can say that non-residents are the sources of funds. Overseas branches of Indian banks, they are the sources of funds. Who can use the funds? Funds are used by residents in the India and the non-residents who are abroad. And also lending to the residents, they have to follow FEMA 1999 rules. Clear? The concept, the overview of the IFSC, that what is IFSC? And you know that there are the relaxations are also given. Relaxations given to the IFSC, like in the IFSC gift cities for the foreign portfolio investors. Why? The most important thing is that IFSC are able to attract the money into the India. It makes the gift city as a global financial hub, and they are able to compete with the centers like Singapore, Dubai, and London. Right? So, what is the meaning of this FPI? Foreign portfolio investor, who can be the foreign individuals, foreign institutions, and also the foreign funds. They can invest in the shares, bonds, derivative commodities. So if a US pension fund investing in Indian stock market, that is FPI. So what are the key relaxations? FPI can be registered in India. They can trade and gift city exchanges. Right? FPIs can trade in commodity derivatives at the IFSC. They are allowed to trade in gold, silver, crude oil. No securities tax, transaction tax. I told you that what is the meaning of STT. It is a direct tax. And commodity transaction tax is basically allowed here. No tax is there. In Indian market, STT is only charged on equity trades and CTT on commodity trades. But at the gift city, there is no STT, no CTT, which gives the benefit of high profit for the investor and more attraction to the IFSC, and also the lower cost of trading. Right? So that is the thing here. Now exchanges are operate 22 hours a day, and there is no additional documentation required. So basically, if the FPI is already registered in India, so no extra registration, no extra paperwork, easy entries are there, very less compliance burden is there, faster operations are there. Got it? So here we can say that these are the things in the IFSC, or just because of these relaxations, gift city become cost effective, investors get benefits here, market become deep and liquid, India become more globally competitive. Got this thing? The complete IFSC overview. Now just in the homework, if you are able to learn this chapter, just do this, fill in the blanks and true false in the homework, and do comment. It takes 2-3 minutes only. Read and do the comment. That will help you to give your tell your strength, right? And if you have any problem, ask me in the comment section. Tomorrow we will meet at the same time with our next chapter. Till then, take care and have a good day all. Thank you.
A very good chapter, having some concepts related to the technologies which are used in the international banking. So let's start with the class. And if you have any doubt, you can ask in the comment section. So let's start with the class here. Now you see that thing in this modern era, everyone is using their mobile phone, everyone using their banks in their mobile phones, and banks also offers the customers this service because this service makes customers connecting with the banks. And also most of the youth, they don't want to go banks, and they want convenience, they want comfortability, they don't have time. So that's why bank offer lots of type of technology to their customers according to the demand of the present era. So we will learn these things in this chapter, that what is the meaning of digitization in the international banking. You know that this digitalization in international banking refers to the use of digital technology such as mobile apps, AI, cloud computing, blockchain, automation to provide banking services across the countries quickly, securely, and efficiently. It replaces traditional paper-based and manual processes with electronic systems for services like foreign remittances, trade finance, international payments, currency exchange, and customer onboarding. So lots of things are available now for the customers that support international banking. Basically, that digitalization, which is one of the most important thing in this today's present era, right? Now, you can say first thing is making the bank more relevant to the customers. Making the bank more relevant to the customers because digitalization help banks understanding the customer needs and also provide personalized services. Customers today, they need everything in seconds. They need quick, resolution. They need simple, fast, or convenient banking solution. How this digitalization help? Online account open, mobile banking app, real-time transaction tracking, and also the personalized offers. And relative benefits of speed in-house talent means we know that this digitalization improve transaction speed, but also need skilled employees to manage the technology, right? And what are the benefits of this speed? Instant fund transfer, real-time currency conversion, and also faster loan approval. And in-house talent means obviously related to the skilled peoples who are required for cybersecurity, data analysis, and system maintenance. It also help in developing digital ecosystem and platforms. A digital ecosystem, that connected system of platform that work together to provide banking services. And what are the components of this digital ecosystem? Payment gateways, as you know that Paytm, UPI, Google Pay, Bhim app, everything. Mobile wallets, Forex trading platforms, blockchain networks, and customer portals that are helpful in developing all the digital ecosystem and platforms. Organizational readiness for reassigning, retraining, recruiting resources. This digitalization changes the job roles in the banks, so organization must prepare the employees. What are the key actions required? Reassigning, moving the staff from manual roles to the digital roles. Retraining, teaching the employees new digital skills. Hiring the experts in the technology. Hiring the experts in the technology. So these are the things which are available now for the customers that makes their banking so relevant and so smooth, right? Now, proactive means predicting the customer needs, and agile means responding quickly. So AI predicts fraud or customer demand. Chatbot provide instant support, and real-time alerts prevent risk. Right? Then self-assessment means evaluation, self-evaluation. Bank regularly evaluate their digital performance and also encourage collaboration among the teams. What are the self-assessment areas? Technology efficiency, customer satisfaction, security performance, employee productivity. What is teamwork importance? Digital banking requires coordination between IT team, compliance team, customer service team, risk management team. And what are the benefits of technology? Accurate. Technology is always accurate because it helps in reducing human errors. Speed, very instant speed. Transaction happens instantly. Swift transfer that earlier took 3 days, now it done in minutes. There is low transaction cost. Automation reduces operational cost. Operational cost means no type of problems in the branch transfers, paperwork, electricity, everything is reduced and it is very easy of doing the business. Customers can access services anytime, anywhere. Better compliance. Obviously, technology help in following international regulations. And there is the reduction in manpower also. Machine handles repetitive tasks. Management information system is very important thing. What is this information system? Like the the news collector who collects all the news from all the department and then report to the senior management that these problems are going on in the organization or in the bank. Business continuity. Operations are continued during crisis also, right? But if there are lots of advantages, can you see, can you think that if advantages are there, so there are limitations also. But what type of limitations are there? What type of limitations are there? First, we can say that if here the thing is limitation is very high type of infrastructure cost, very high infrastructure cost means it requires expensive hardware, software, and also cloud systems, right? Then there are technical glitches also. Technical glitches means system failures disrupt the services, like servers crash, which delays the international transfer. Customer awareness issues are there, like bank impose limits for the security, impact on customer service, like lack of human interaction reduces the satisfaction. There are security risk and also increase in cyber crimes, right? External fraud threats are also there. So some are the limitations also of the technology, right? So we can say that digitalization has transformed international banking by just improving speed, efficiency, accuracy, and customer experience. However, challenges like cyber security risk, higher cost, and customer awareness must be addressed for sustainable growth. But there are some digital platforms in the international banking. What are the digital platforms? Inward remittance means money received from the foreign countries through the digital platforms. Inward remittance refers to the money received from the foreign countries through the digital platforms. And what are the benefits of online inward remittance platform? Quick and seamless transfer. Money reaches instantly from the abroad. Then fixed and fair exchange rates, 27 into 7 customer support. And apart from this, you can say this is basically benefits of the outward remittance. Outward remittance, when someone is sending the money outside the country through the digital banking channels such as internet banking or mobile banking. Online outward remittance always allows the customers send the money abroad 24 into the 7 without visiting a bank branch subject to the regulatory permissions.